Welcome, everyone. Thank you for joining us for this special Climbing Mount Debt is Repayment Restarting, Student Loan Strategies and Maximizing the Special Forbearance Benefits. My name is Jordan Ben-Shia. I'm the Executive Director of the VIN Foundation, and we're thrilled to have you with us for this special webinar. Our presenter this evening is Dr. Tony Bartels. Many of you probably know him. He's a student debt expert and a VIN Foundation board member. And we also have with us Charnette Lewis, the VIN Foundation's newest program manager, along with Dr. Rebecca Mears and Dr. Matt Holland. And all of us are going to be in the background helping to answer questions and making this webinar hopefully go as smoothly as possible. So a couple housekeeping tips. You will receive a recording of this webinar. That is the #1 question that we get every time. So you will receive a recording of this webinar. We'll be sending you an email within the next couple of days from a vinfoundation.org email address. So keep a lookout for that in your inbox. And we want to keep the chat box, the chat area, to technical questions only. So any technical issues, go ahead and put those in the chat window. And we really do want to encourage you to ask questions. And to do that, we want you to engage that Q&A box that's at the bottom of your screen. And we've also enabled the upvote feature. So if you see a question that you think is relevant and you want to make sure is answered, go ahead and give that a thumbs up. And that'll help bump it to the top of the list so we can make sure to answer that. Some of the questions we'll be typing in and answering, and some of them you will hear me in the background bringing up when Tony is presenting. So with that, I'm going to turn it over to Dr. Tony Bartels.
Thank you, Jordan, and thank you everyone for joining. And for those of you, special thanks to those of you that filled out the student debt and income signalment form. Those are super helpful in helping me pull together the information that we're going to cover to try to make it as relevant as possible. Becky and I were going through some of that this morning, and so did a little breakdown. So there was most of you, or the largest concern was affording the forgiveness tax. And that is a common question that comes up a lot. Certainly something we'll talk about, but also something that's way, way into the future, right? So kind of want to back it up a little bit and talk a little bit more about what's happening recently and more imminently, and who knows, maybe there won't even be a tax, right? So there's things like that that we should talk about as well. But just getting a better handle on your student loans as they currently stand, applying the information we know from the Department of Education that was just released today, using that to our advantage, and then integrating that into a short and long-term comprehensive repayment strategy. Some of the other things that we tried to categorize that fall into a less defined category have more to do with just a general feeling of being overwhelmed, and I totally understand that. That's what I'm hoping we can alleviate here tonight, right? Because I think a lot of the feelings of being overwhelmed have more to do with the uncertainty around student loans, the fact that we've been in this weird pause and it's not really clear what we should do or shouldn't do. And that's the stuff I want to focus on tonight. All right. And so we're going to try to answer all the questions around that and maybe relieve some of that anxiety around, feeling overwhelmed. There was a significant number of questions about public service loan forgiveness as well. So some of you that are working towards it, and it sounds like some of you that are very close to receiving it, which is excellent. So we want to make sure that everybody's familiar with what that is. But I also want to differentiate public service loan forgiveness from the other type of forgiveness that people associate with the tax, right? Because those are very different things, right? So we have to make sure that we are able to differentiate those and know which kind of forgiveness that we're talking about when we're assessing something like a forgiveness strategy. All right, so I'm going to dive in here. And again, feel free to type in any questions along the way. A lot of you provided some excellent questions, and you'll see those peppered throughout the presentation. And we're going to get through as much of that as we can and make sure that everybody gets the questions that they have answered. So is repayment restarting? Not yet, right? So we just learned today from the Department of Education that the deadline was extended again. I think this is the 6th extension. So there will be no payments, no interest, still getting forgiveness credit if you're using an income-driven repayment plan or working towards public service loan forgiveness. That extension is now through August 31st, right? So we've kicked the can down the road another 4 months. Which is great, right? Because it gives us some flexibility to really work through this. For some of you, it really gives you a chance to assess which repayment options you have available to you and choose the right one without really being penalized, right? You almost get kind of a do-over, which is really, really rare when it comes to student loans. So we've got some special notes for those of you that are 2021, 2020, 2022 graduates, because that's been a unique experience, even on top of all of the pandemic forbearance benefits that we've been receiving for those of us in repayment. So I thought this question really summed it up best, right? So how am I supposed to manage forgiveness with financial planning? I have no system in place and don't know where to start. All I have is a checking and savings account and make monthly loan payments. So yeah, I mean, that's what we want to treat, right? So so thanks for whoever contributed that, right? Because I feel like it really does a good job of of putting into short words what everybody's feeling. No system in place. Well, that's what we're going to go through tonight. I'm going to show you how you can develop that system. The fact that you have a checking and savings account is a great start, right? But we want to start looking beyond that and seeing what we might do to improve our overall financial wellness and wealth, and not necessarily worry about our student loans so much, right? So, and I'm making monthly student loan payments. That one actually kind of concerns me a little bit, right? So depending on where you fall in the student debt to income spectrum, where which we're also going to talk about a lot tonight, it may not make sense for you to be making payments during this pandemic forbearance period, right? So use that to your advantage so you can boost some of those other more critical areas of your financial wellness. So setting up those systems, right? Just like we do with our clinical cases, we're going to do a physical exam and diagnostics on our student loans, and then we're going to come up with some prescriptions and treatment plans based on what we find in that physical exam and diagnostics. So I asked you guys for a student loan history and signalment. I'm going to give you some of mine. So I'm married, 2-vet household with no kids yet, although that is happening days from now. So within the next 2 weeks or so, my wife and I will be welcoming our first daughter to the household. So that's going to change everything, including our student loan repayment strategy. So we've got that to look forward to. But combined, we have in excess of $400,000 of student loans, all of that federal student loans that we've amassed mostly from veterinary school. I did more of the GP route. So was an in-state student at Colorado State. My wife was an out-of-state student at Colorado State, did an internship fellowship, and then went on to specialize in small animal internal medicine. So we learned a lot about what to do and what not to do in various pathways after veterinary school in veterinary medicine. For those of you that are new to this repayment thing, right? So those of you that have graduated into the pandemic forbearance, which now we're going to be looking at our 3rd graduating class, graduating into this pandemic forbearance period. If you don't choose a repayment plan, your loans get put into a standard 10-year time-driven repayment plan. So basically they take your total student loan balance, the interest rates on that, and calculate a monthly payment to extinguish that balance over a 10-year time frame, or 120 monthly payments. For us, that would have been $4,500 per month, which was more than we were earning. So we weren't able to pursue that type of repayment plan even if we wanted to. So stumble upon these income-driven repayment options. As the name implies, the payments are a function of your income, right? So rather than having the payment be a function of your balance and your interest rates, the payments under an income-driven repayment plan, which are quite unique to federal student loans, are based on your income. Right? So we started off using one called income-based repayment. That got our payment down to $1,400 a month. We have since switched and currently are using a plan called Revised Pay-As-You-Earn, and that got our payment even lower. Right? So there are various types of income-driven repayment options available through the federal student loan system. Your task and challenge is to choose the one that's most appropriate for your circumstances. So we file our taxes jointly. We're kind of in the midst. I'm actually meeting with our accountant tomorrow to go through the final touches on our tax return so we can submit that before the tax filing deadline. That makes sense for us because we both have student debt and the best repayment option that we can use is revised pay-as-you-earn. And the way that revised pay-as-you-earn is set up, it generally doesn't favor you filing your taxes separately from your spouse, right? There's no benefit from our student loans in doing so, right? So these are things that we're going to talk about tonight. How do you decide which is your best filing status, depending on the income-driven plans that you're eligible to use and what your household configuration looks like, right? Does your spouse have student debt? What's your spouse's income relative to yours? Is anybody in the household working towards public service loan forgiveness? Those are the types of things that we want to consider when we're thinking about what's the best way to file our taxes, since we're in this tax filing season as well. We're making payments based on our income. We currently don't have to, right? Because the pandemic forbearance has actually shut off the payments for those of us that are in repayment as well, right? So there's no payments, no interest. The time that we spend during this pandemic forbearance period also counts towards forgiveness. So we don't have to worry about being in repayment any longer. So for those of us that are using an income-driven repayment strategy, this pandemic forbearance period has been extremely beneficial, right? There's been no payments, so we get to pocket that extra cash, no interest accruing, so our loan balance doesn't grow if our payment was less than our interest accrual previously. And the time that we've been in this pandemic forbearance period also counts towards forgiveness as long as we're using an income-driven repayment plan. So we are planning and saving for forgiveness. It's quite likely that we're going to hit the forgiveness using revised pay-as-you-earn, and that'll happen 15 years from now for us, so around 2037. And we're actively planning for that forgiveness, right? So a lot of you ask questions about forgiveness planning, right? So this is a snapshot of the bulk of our forgiveness plan, if you will. I use a platform called Wealthfront. That just happens to be the one that I chose. I like the features that it has available, but it is a collection of robo-advisors. There's dozens of these things out there. So Betterment, Ellevest, Vanguard, Schwab, all of them have kind of their version of these automated investing platforms where you can tell them what your risk tolerance is essentially and contribute money on a periodic basis, and they will allocate those funds across a low cost diversified portfolio that generally tracks the stock market performance depending on what your risk tolerance is, right? So the dotted line here is my contributions. I started this around 2014, 2015. The solid line represents the value, right? So the difference between these is basically the dividends and the appreciation and the value of this combination of investments, right? So essentially I'm using the power of time, interest, and appreciation to make up some of the difference between what I need to have on hand if I have to pay a tax and what I have to contribute. Right, so I'm generally earning about 10% per year on average across this forgiveness savings plan. I don't anticipate that to stay the same forever. And as I get closer to forgiveness, I'm going to think about winding this down, right? Because I don't want it exposed to too many risky assets as I'm approaching forgiveness. Right now, I'd say I'm probably around a 7 or 8 if I'm looking at it on a scale of 1 to 10, with 1 being the most conservative and 10 being the most aggressive. But I would probably give it about a 7 or 8. And as I get a little bit closer, I'll start to wind that down and make it a little bit more conservative so I can preserve some of that value in case I do have to pay that tax. But the key there is to get started. And the pandemic forbearance benefits is a great excuse to get started if you haven't allocated a specific amount towards your forgiveness savings plan if you anticipate reaching forgiveness. So how do we do a good physical exam of our student loans, right? So a lot of you submitted your student debt and income statement form, and thank you for doing that, but many of you didn't include the student aid data file, right? So I just want to make sure that everybody knows how to find this, right? And there's going to be a couple of good things we're going to see here. This is the studentaid.gov website. So this is the dashboard for everything federal student loans. You'll see here that it just announced student loan payment pause extended through August 31st. This just got updated today, right? And if you click on that, that has more information about that. But really the only difference behind there is the dates now being extended from May 1st to now August 31st. I'm going to log in here and I'm going to use the same username and password that I used to apply for my student loans, right? So for those of you that are not too far removed from school, you'll still probably have this information handy. If not, you can create it, right? So you can use your social security number and create your username and password so you can get in here. We can see here that of the total household balance, I've got about 171, 163 of that is principal, 7,700 is interest, unpaid interest, right? So this is what happens when we're in repayment and you have a payment that's less than the interest that accrues, right? Your interest gets sent to this separate unpaid interest bucket. And one of the benefits of income-driven repayment is that I don't accrue any interest on this interest, right? I accrue interest on the principal, but any interest that I'm not paying gets thrown into this unpaid interest bucket. And as long as I do the income-driven repayment plan correctly, I can keep this unpaid interest off my principal, right? So some of you that have been using this for a while will notice maybe a hefty unpaid interest balance, right? Some of you that have graduated during this pandemic forbearance period, you may not have an unpaid interest balance, right? So the interest that you accrued during school will have gotten capitalized and added to your principal as part of your grace period ending and officially entering repayment. But since we've been in the pandemic forbearance period, your unpaid interest would be zero, right? So you're going to see various differences there depending on your circumstances. So that's not enough information for me to make any decisions or to find my file. So I have to hit the view details link and I get taken to this age summary page, right? So again, more information, still not all of the information I need. The information I need is in this download my aid data, right? And you're only going to see this link if you're going to access this site on some kind of laptop or something that's going to allow you to save files to your computer. Because when I click this, it's going to ask me to save my ugly looking file, which is a text document, somewhere onto my device, right? iPhones are not very, favorable for saving files to off the internet, right? So you may not be able to access that if you're filling that out or looking at this on your iPhone. But save that file, and we're going to come back and use that in just a few minutes. So based on the information that you all sent to me, right? So I kind of went through the signalment form submissions and processed this. And this is, again, eye-opening, right? Because it's amazing how every one of these sessions that we do is just a little bit different depending on who's interested and who's attending. But I would say that this particular one, for those of you that submitted the student debt and income signalment forms, are at the higher end of the debt to income spectrum, right? So that was something that was curious to see. And we're going to talk a lot tonight about student debt to income ratio, right? So I take my student debt, I divide it by my income, I get a debt to income ratio, right? So when I have a debt to income ratio of 2 would be, I've got $200,000 of student loans and $100,000 income, right? 200,000 divided by 100,000 equals 2. Right. So we can see that the majority of you reported to me that your debt to income ratio was greater than 3. Right. And then the next largest chunk was between 2 and 3. Right. And then we've got some smaller chunks down less than 2. We've got a good smattering of folks that are among the various graduating classes. Most of them are 2020, 2021, 2022, right? So we've got some special things to talk about with you all. And then everybody else is probably familiar with what repayment actually looks like. The average debt that you all reported to me for this session was about $275,000 with an average reported income of about 91. If I take the average debt to income ratio, so if I calculate your debt divided by your income and then average that number, the average that I got was about 3.4, right? So that's, again, a little higher than we typically see, particularly, compared to the data that comes out of the AVMA for, say, recent graduates. So some of the chief complaints that you all told me, this is how I kind of structure these presentations. These are the things that I want to cover, right? So a lot of really good comments and questions here. So this one in particular, right? Inability to make payments. My partners and my educational debt has made it so we are not able to buy house, car, or savings. I hope after this session tonight that this is no longer true, right? And if not, then please, reach out and I'll show you guys all tonight how you can get personalized assistance in terms of making sense of all this stuff if you're not confident in how to do this exactly. But student debt should never prevent you from being able to buy a home, buy a car, or do any kind of savings, right? Not your federal student debt, right? Your federal student debt always has an option for you to be able to peg the payment to a manageable percentage of your income when we're actually in repayment, right? So you can do those other things. You can buy a home, you can buy a car, you can save for retirement, right? You can start a family, right? Your student debt should not prevent you from doing that. Only the options you choose may prevent you from doing that. So let's make sure that you know all of the options that are available to you. This one is a particularly timely and common one right now, right? So payment amount in regards to last year's taxes. Do I have to resubmit tax statements each year? So a couple of things wrapped up in there. During the pandemic forbearance period, and we're going to cover those details in just a minute, you do not have to recertify your income, right? Because there's no payment due, right? So that they pause the normal recertification that you have to provide that income documentation to keep your payment based on your income, right? So there is no requirement for you to provide your documentation. When it comes to tax statements, right, your tax filing status the last couple of years is something that we really should spend a lot of time talking about tonight, right? So there's very many instances where sometimes it makes sense for you to file your taxes separately from your spouse when you're using an income-driven repayment plan, particularly if you're the veterinarian with the veterinary education size student debt balance and your spouse doesn't have any student debt, right? In those cases, it often makes sense for you to file your taxes separately from your spouse. But the last 2 years, nobody's had to make a payment on their federal student loans. So maybe it makes sense during this pandemic forbearance period to file your taxes jointly, right? Because you're not going to have a payment due, most of us probably until well into 2023. That's going to be based on our current or future incomes, right? So you might be able to benefit from the joint tax filing benefits during this pandemic forbearance period, and then think about filing your taxes separately once the pandemic forbearance actually ends. I like this one, forgiveness with an IDR plan in 2036. I love people that know about when they're going to reach forgiveness, right? Start thinking about when you started using these income-driven repayment plans, what the maximum repayment period is, and where you expect to be in terms of hitting forgiveness, right? So pay as you earn has a 20-year maximum repayment time frame, right? Revised pay as you earn has a 25-year maximum repayment time frame, right? So depending on when you started using your income-driven repayment plans, that's what's going to determine when you're going to hit forgiveness. This one was probably my favorite, right? Do I need to divorce my husband? Pros and cons about claiming your taxes together or separate with kids. Usually it's the alternate question I get. Usually it's like, should I get married, right? My student debt, maybe it's better if we don't get married, right? And I generally don't encourage anyone to make marital decisions based on their student loans alone, right? There's usually a way for you to separate your income from your spouse using an income-driven repayment plan if your circumstances require you to do so. Same thing, right? You probably don't need to divorce your spouse just because of your student loans, right? There's probably an option out there for you to separate your income by filing your taxes separately rather than divorcing your spouse, right? Now, some people may decide that that still makes sense, right? But I generally don't, recommend anybody makes any major marital decisions strictly based on their student loans. So here we can see a couple of different, so this person is completing IBR payments after 25 years, loan forgiveness after 20 years, right? So that reflects the differences in the different repayment plans, right? So the old version of IBR, the revised pay as you earn have 25-year repayment timeframes. Pay as you earn has a 20-year repayment timeframe, and then public service loan forgiveness has a 10-year timeframe, right? So we've got different repayment timeframes depending on our strategy and our income-driven repayment options. In terms of is it worth it? It really depends, right? It's going to depend on your circumstances. It's going to depend on where you fall in this debt to income ratio spectrum, right? So the higher your debt to income ratio, the more sense it makes to use an income-driven repayment plan, pay the minimum, and plan for the forgiveness. How not to be indebted until death, right? So this is another common one, right? Unless you plan on dying within that 20 or 25-year time frame of when you started repayment, that's not something you should worry about, right? Your student loan payments will end, right? Either your income will be high enough for you to pay that balance to zero, or you'll hit forgiveness, right? Either way, loan repayment will end, right? It may not end as fast as you would like, right? But sometimes, we kind of deal with the cards that were dealt, right? Sorry, this one got kind of cut off there, but that says would like to pay it off ASAP. We all would, right? But we have to make sure that we're paying off our loans smartly, right? That we're actually using the resources that we have available at our disposal in a fashion that allows us to do something other than just pay down our student loans, right? So there's a lot of other things that are going to be more beneficial that you can do with your money and that you should be doing with your money sooner rather than later, that include things other than just paying down your student loans. Okay, so what do we know so far when it comes to the pandemic student loan forbearance? So today they came out and announced that the extension will be extended again, so the fifth or sixth time now, through August 31st, right? And who knows if that'll be the last one. This one was supposed to be the last one, but they kicked the can down the road again. It's for federally held loans only, right? So it won't apply to private student loans, and even certain federal student loans don't fall under the pandemic student loan forbearance benefits. What is the best way to approach it, right? And this is a good question. I thought that kind of summed this up. Should I be making payments now or just setting money aside until they finally decide to restart interest? So how about you guys tell me in the chat box a little bit how you've been approaching the pandemic forbearance period? What have you been doing when it comes to this bonus time that we haven't had to make any payments?
We have a couple of questions, Tony. So I know that you're going to get to some of this, but we can ask a couple if you want.
Yeah, sure.
So if we are graduating this year, when would we need to apply for an income-based repayment plan before the loan provider automatically places it in the standard 10-year plan?
Yeah, I'm going to get to that one in just a few minutes. So hold off on that. I've got a special set of slides for that group in particular.
Another one is to confirm I do not have to recertify my IDR because we're currently not making payments, correct?
That is correct, right? So you do not have to, there is no requirement to recertify your income for an income-driven repayment plan during the pandemic forbearance period. And we're going to cover that in just a few minutes too, a little bit more on that. So I see some people typing in some great comments here. So saving, I'm working on the public service loan forgiveness. I have not been making payments and using that money for investments. That's outstanding. That's a great idea. Continue to pay, paying off my credit card with the money that would have gone to my student loans. Excellent idea, right? Saving and maxing out Roth IRA for my tax forgiveness. Well, that's a loaded one, right? I love the saving and maxing out my Roth IRA. Awesome idea, right? Well, we should all be doing that. I wouldn't necessarily allocate a Roth IRA for your forgiveness savings plan, right? Keep your retirement savings for your retirement, right? If you anticipate hitting forgiveness and you need to save something for that, then start something separate for that, right? We don't want to be robbing from our retirement funds to potentially have to pay a tax on our student loans, right? So max out the Roth IRA, but also see if you can figure out a way to save separately for that forgiveness savings fund. All right, great. These are some excellent comments. Refinance our home and pay down med loans. Excellent, right? So yeah, generally speaking, this is going to depend on where you fall on the spectrum, right? The higher your debt to income ratio, the more you want to not do anything, right? During this pandemic forbearance period, just enjoy it. Right? Enjoy the no payments, no interest, the forgiveness credit. If you're going to hit forgiveness, you want to pay as little as you have to anyway, right? In the pandemic forbearance period, it just made that more obvious, right? So look for other ways to shore up your financial wellness, right? So tax advantage retirement savings is a great way. Jumpstarting your forgiveness plan if you haven't started that yet, saving for the down payment on a home or starting a family, or changing out that old beater vehicle if you have to, right? Those are good ways to use this to your advantage to shore up those other areas of your financial wellness. You can even request a refund, right? So some of you, and I've got even an example I'm going to use here in a minute of somebody who I believe is going to hit forgiveness and has made $4,000 of payments towards their student loans during this pandemic forbearance period. Would that money be better used somewhere else? And the CARES Act that set in place the pandemic forbearance period allows for you to request a refund of any payments that you've made towards your federal student loans since the pandemic forbearance period began, right? So any payments that you may have made from March 13th, 2020 through now, or through the end of the forgiveness or the pandemic period, you can request a refund of those payments, right? So if you have a plan to use that money in a different way, then request a refund of those payments. We cover this periodically. We'll probably do another updated podcast too to just go through some of this stuff in brief, kind of like we're doing tonight. But this probably won't be brief, right? But we'll do the podcast to kind of make it a little more succinct too. But we've been covering a lot of those updates along the way on the VIN Foundation podcast. So recertification deadlines. A lot of questions about that, right? So you won't be required to recertify. The earliest you could be required to certify is November of 2022. Right now, that even may get pushed back, right? This was the date that was established when the pandemic forbearance deadline was at May 1st, right? So we may or may not see this get extended further as well. If your recertification date fell before November 2nd, then you can take whatever that date was and add a year to it. Right now, some of you will see that in your files, and I'll show you what that looks like too. And that's another reason why you should go get your My Student Aid data files so you can see what your recertification date is. Right? Some of the loan servicers have updated them, others have not. Right? But we can make sense of when we can think or when we will next need to recertify our income based on what we find in that file, and that can really help to inform something like our tax filing decision for this year. Right? If I don't have to recertify my income until October 2023, and I normally file my taxes separately to get student loan benefits, well, I can file my taxes jointly this year to receive the joint filing benefits and worry about filing my taxes separately for 2022 because I don't have to provide any documentation until late 2023. Right? So it's not just about the deadline. It's not just about the August 31st. It's about how far in the future too our recertification dates have been pushed into the future, which also provides an additional layer of flexibility. If you do need to renew your income, right? So reasons why you might provide income documentation now, even though you technically don't have to. If you haven't chosen a repayment plan yet, right? So if you're in one of those recent graduating classes and you haven't chosen a repayment plan, you can apply for an income-driven repayment plan, right? And when you do, you will have to provide income documentation. You can, up through at least July 31st, just do a self-reporting of your income, right? This is a pretty new feature. Previously, you had to use a tax return or some kind of pay stub, some hard evidence of your income. But we've got this flexibility through at least the end of July where you can just simply type your income in a box, essentially self-report your income if you have all direct loans, right? But the only reason you really need to do that is if you haven't chosen a plan and you're going to choose an income-driven repayment plan, or if when the pandemic forbearance period ends, your payment would be higher than your current income would support, right? And we'll show you how you can calculate what that number is too. So is it worthwhile to pay off my outstanding interest and some principal now? It depends. I would encourage you to run a student loan repayment simulation using the VIN Foundation Student Loan Repayment Simulator. If you keep bumping up against a forgiveness using an income-driven repayment plan, then it does not make sense for you to pay any of the interest and principal now, right? Just like the example that I'm going to show you in just a couple minutes here. So these are the questions I think you should be thinking about in regards to the recertification deadlines, right? So what was your payment before, right? What would it be now? Right? What plan were you using before the benefit started, right? That's going to be really important. And when will your next renewal be? All right, so how do we learn all of that, right? This is where this physical exam comes in. So in your student aid data file, you're going to find a whole bunch of stuff, right? Most of you are just going to see direct loan types, right? So some of you, those of you like myself who were in higher education before 2010, you may see some federal family education loan types, right? So these were discontinued after July 2010, but they're still out there, right? If you borrowed them and unless you paid them off, they're still going to be on your ledger, right? And they have a different contract, a different set of repayment options available. They are a type of federal student loan. Same with Perkins loans, health profession student loans, loans for disadvantaged students. Private loans are going to be anything that doesn't fall into that category. You know, over 90, those of you that submitted the signalment form for tonight, you know, almost 100% of you had direct loan federal family education loans or Perkins loan types. Some of you confuse the Grad Plus loans with like an other loan. That's pretty common. Grad Plus loans are a type of direct loan, right? Well, they can also be a type of federal family education loan, right? But grad plus loans are federal student loans. You have to apply for them a little bit separately, but they are still a type of federal student loan. When it comes to whether or not they're eligible for the pandemic forbearance benefits, all direct loans are, right? No questions asked. Federal family education loans, it depends, right? It depends on whether they're, quote, federally held. And we can see that in your student aid data file. Perkins, health profession student loans, loans for disadvantaged students are not, right? They're not, quote, federally held. They are a federal student loan type, but they're not federally held. So they're not subject to this pandemic forbearance benefit. Private loans don't have anything to do with the federal pandemic forbearance benefits, right? There was some relief for some private loans, but that most of that has since expired. And it really depended upon the private lender that was providing those particular benefits. If you lost track of anything, check your credit report. It's always a good habit to get into. Annualcreditreport.com. You can check a free report from the major reporting entities at least once per year. I think they're letting you do that once per week during the pandemic period. For those loans that aren't, quote, federally held, you can make them eligible for the pandemic forbearance, as well as some of the more beneficial income-driven repayment plans with a consolidation loan, right? So a direct consolidation loan will take all of these and put them into this direct loan category. Now, you have to be really careful about the timing of this, right? Generally, we recommend new grads use direct consolidation loans as soon as they can after graduation, right? That's the best time to use a consolidation because it reduces the side effects of consolidation, right? If you've been out for 5, 10 years and you've been using an income-driven repayment plan and you decide you want to consolidate now, you may erase all of that forgiveness progress. Right, so you have to be very, very careful about how you use a consolidation loan if you've been out of school for a while. And this is where, you know, this pandemic forbearance benefit, hindsight, right? If you go back to the beginning, March 2020, you know, if you had the foresight to know, wow, they're going to turn off student loan payment for 2.5 years, it would have been a great opportunity to consolidate any loans that I may not have been subject to the pandemic forbearance benefits, but doing it now, you know, it depends on how much of a gambler you are, right? Do you want to do it for that extra 5 months, or are you going to assume that it's going to get extended again, right? That's something I would encourage you to seek some assistance on, you know, maybe on the student debt message board folder on VIN or VIN Foundation, where we can talk through something like that. All right, so let's take that student aid data file and upload it into the My Student Loans portal, right? So we can start to see where we can find some of this information.
We have a question here, Tony, that you just kind of covered. So I want to make sure that before we get too far,
sure.
Can you please explain again the IDR recertification date? You mentioned adding a year from the date and it confused me.
Yeah, all right. So let me do that with an example here. So this is the VIN Foundation Student Debt Center, and I'm on the My Student Loans tool, right? So once you have your student aid data file, this is where you're going to go. My Student Loans page. If you're still in school, you'd use this middle box. If you've graduated, you'd use this box on the right. There's also a video down here, tutorial, that kind of shows you the steps that I went through to help you find that file, right? So there's a lot of good information on this page. I'm going to take a file that I've uploaded previously in here. I've got too many folders, and here is one. This is a 2021 grad, right? So this person graduated into the pandemic forbearance period, right? However, they have chosen a repayment plan, right? So you can choose a repayment plan, and they did after their grace period ended, right? They applied for pay as you earn. They got a monthly payment of $0, right? But they're currently in pay as you earn, earning forgiveness credit since they entered the pandemic forbearance period, which was after their grace period ended. So maybe, you know, 3/4 of the way through the 2021 calendar year. And we can see here that the anniversary date for their pay as you earn, this one's already been pushed forward in the future, right? So this one's been updated, right? So they don't have to provide additional income documentation until July of 2023, right? So more than a year from now, right? So even if the pandemic forbearance benefits end after August 31st, their payment will still be zero for almost another year after that, at which time they would then provide updated income documentation based on their most recently filed tax return. Right. So this is a lot of really good information. We see the loans, the interest rates are shut off. I see I've got 20 different loans. My loans are with Aidvantage. They're the ones that took over for Navient, right? So if you formerly had Navient, your loans got moved to Aidvantage. I can see my income-driven repayment eligibility, right? If I'm not sure which plans I'm eligible to use, I click on this income-driven repayment eligibility tab. This person's eligible for IBR 2009. They're using pay-as-you-earn. We see they're eligible for it, as well as revised pay-as-you-earn, the plan my wife and I are using, right? And the only reason my wife and I are using revised pay-as-you-earn is because we're not eligible for pay-as-you-earn, right? We don't meet the new borrower requirements. Generally speaking, pay-as-you-earn is going to be the most beneficial repayment strategy for nearly every recent graduate veterinarian, right? There are certain exceptions to that, and we'll talk about some of those, but I'm usually looking first and foremost to see if somebody's eligible for pay-as-you-earn and whether or not they're using it, right? So the show details here, I see they're actually using it, which is great, right? I know that they've chosen a repayment strategy. I know they don't have to renew for a long period of time, right? This is also someone, and you can't see this yet, but we're working on this. This is probably going to come out next week, but this person is the person that's made $4,000 of payments during the pandemic forbearance period, right? Their debt to income ratio, they're currently earning or reporting to me that they're earning $100,000 a year, right? Their debt to income ratio is greater than 2. It is quite likely that they're going to hit forgiveness, right? In that context, I wouldn't pay any more than I have to towards my student loans, right? So I would request a refund of those payments and redirect that $4,000 to other areas of my financial wellness, like maxing out a retirement plan, right? Maxing out a Roth IRA, right? Saving for the down payment on a home, boosting an emergency fund, right? A lot of good ways to use that money versus putting it towards your student loans when you don't have to. So here's how I would know whether or not I'm due to hit forgiveness. I'm going to send this information over to the loan repayment simulator, right? It's going to fill a lot of this information in for you, right? I know that I've been using pay-as-you-earn almost a year, not quite a year. I'm going to guess the interest rate, right? So for recent grads, I'm going to guess about 5.5% on this one, right? And that would probably include a 0.25% interest rate discount once we're in repayment, assuming you're going to use auto pay. Right now, the simulator is assuming that the pandemic forbearance period is going to end on May 1st, but we've got a function in here where we can extend it through the 1st of September, right? So we know that that information is actually accurate, right? I also know they have got $100,000 income, right? But I also know my payment is going to be zero for another year because my recertification date isn't until January or July of 2023, right? So I can put zero in there again, right? And at that point, when I recertify in 2023, I'll probably be using my 2022 tax return information, which might be closer to this, right? Depending on what their adjusted gross income looks like, right? So I can fill that out. Here's some additional information. This person's not married, right? But if they were to get married or shortly in the future and you knew that information, you can add that to the simulator for the settings, right? If you have children or you're planning to have children, you can add those to the settings as well, right? If you're planning to hit forgiveness and you want to put a tax rate in there, right? And a savings rate for your forgiveness savings plan, you can put those in before you run the simulation. You can also change those after. The poverty growth rate, probably need to adjust this a little bit upwards. This has to do with the discretionary income calculation that calculates your monthly income driven repayment plan amount. And this generally tracks inflation. So it had been really low for a while. It's going to start creeping up, but over a long period of time, it's probably going to be somewhere between 2 and 3%. So I'm going to run that simulation, and this is going to kind of give me that just a screening test, if you will, of what my payments might be in the short term, but also if I'm going to hit forgiveness, right? So I'm scanning down here. I'm using pay-as-you-earn. I'm looking. I see I've got principal forgiven. I've got unpaid interest forgiven, right? Which means my balance forgiven is actually more than what I started with, right? I'm going to assume a tax rate of 30% on that. That means I need about $76,000 if I have to pay a tax 19 years from now, right? If I keep scrolling down and I look at that forgiveness planning module, right? I can start to break that into manageable chunks. I need 75,000. If I assume a savings rate of 3% on that, right? I need to save about $250 a month. That would cost me $56,000 to have the $76,000 on hand. If I earn an average of 3%, that brings my costs down by another $20,000, right? My pay-as-you-earn repayment strategy is a lot less expensive than even trying to pay it off sooner under a standard 10-year amount, right? So why would I pay more than I have to just to pay more in total when I can do this, have extreme cash flow flexibility, right? We've got a couple of rows here that shows you the difference in the payments between something like a standard 10-year versus an income-driven plan, right? I can do a lot better things with that cash in that short term and long term while keeping my costs down. And this helps me to make that decision, right? And also gives me some guidance on what I should think about doing in terms of a forgiveness savings plan, right? So that's kind of the, you know, the high level overview, how we use the My Student Loans tool to analyze our student loans, send that over to the simulator to see what our long-term repayment looks like and which repayment option is going to give us the most flexibility, as well as the lowest total repayment cost if possible.
We've got a couple questions here I thought I'd throw in.
Sure.
When is as soon as possible after graduation? As in, can we do this the next day, or just trying to make a detailed plan?
It depends, right? For most of you, you graduate, you know, either at the end of April, middle of May, right? You should be able to safely start your direct consolidation loan by June 1st, if not sooner. For some of you, what you're waiting for is your direct unsubsidized loans to officially enter their grace period. Sometimes that happens the day after you graduate. Other times it doesn't happen until the following month after graduation. And for some reason, for some schools and some folks, it takes even longer, right? But if it takes longer than the first of the month after your graduation month, then I would call your loan servicer or call your financial aid office and ask them why your loans are not in their grace period yet. But once your loans are in the grace period, then you can start the direct consolidation process, right? So for those of you that are 2020 or 2021 grads, if you haven't chosen a repayment plan yet, your loans are technically in a standard 10-year plan, right? And if you want to avoid that honking payment after August 31st, then choose an income-driven plan, right? But don't consolidate, right? Unless you've got a really, really messy loan portfolio. And if that's the case, then I would encourage you to reach out so we can look through that, right? But you probably don't want to consolidate if you're a 2020 or 2021 grad, right? Because the standard 10-year plan time technically should count towards forgiveness, right? So you want to preserve any forgiveness time that you may have if you anticipate reaching forgiveness and you're going to start using an income-driven repayment plan, right? So better to use a recent tax return, or you can even use the self-reporting feature if you have all direct loans, right? And put in what your taxable income is. The class of 2022, that was just a question we just answered, right? So if you haven't filed a tax return for 2021 yet, file one. Right? You can voluntarily file a tax return, even if you don't have any income, even if your parents claim you as a dependent. File a tax return before the tax filing deadline. You'll have an adjusted gross income on file that you can use when you apply for your income-driven payment as part of the consolidation. That will secure a $0 payment on your student loans, just like this person has, right? Just like this 2021 grad who applied for pay-as-you-earn and got a $0 payment, you can have that too if you have that tax return on file, right? That will assure that you can get that $0 payment for the first 12 months.
Okay, you kind of just answered this, but just so that this person's able to hear their question. Coming from a soon-to-be new grad going into an internship, my accountant told me I did not make enough income to file taxes for 2021. Will this affect my application for payee? Can I use my 2020 tax information to ensure I get the $0 monthly payment after graduation?
So file one anyway, right? Same thing applies, right? So voluntarily file. If you don't have enough income to file a tax return, then that's a great reason to file the tax return for student loan repayment purposes, right? Have that documentation on hand. So when you do have to go use any kind of income documentation to renew or apply for an income-driven repayment plan, you'll have it, right? And if it's zero, right, or very low because you don't reach the income threshold to officially have to file a tax return, then your payment will be zero, right? So, file the tax return. Even if your accountant tells you don't have enough income to do it, you can still voluntarily file one, and you can use an online filing service that doesn't charge you anything to do so.
And then somebody says, where do we find what payment program we're on? I applied after graduation in 2020 for payee, but my loan servicer has not given me a direct answer and tells me it doesn't matter while in forbearance.
Yeah, so I would encourage you to upload your file, right? So go find your student aid data file, upload it, and see if they reflect your repayment plan here like it is for this person, right? If they process that application, then they'll put you in that repayment plan. I've got another example of somebody who isn't in, or what it looks like in your file if you haven't chosen a repayment plan or your loan servicer hasn't officially put you into one. So let me upload that one.
While you're doing that, somebody is going to ask this question, which is, can we make payments now on Pslf while we are in deferment to count towards our accumulated Pslf time?
No. And you don't need to. So the pandemic forbearance period time already counts towards forgiveness. If you were using an income-driven plan and you're still working in an eligible public service loan forgiveness employer, there's no reason to make a payment. The time is counting, right? And the public service loan forgiveness, you do not want to pay a dime more than you have to. You want to have the most amount forgiven tax-free as possible. Right? So if they're going to give you credit without having to make a payment, then take it, right? Just make sure that you're documenting your public service loan forgiveness time using a public service loan forgiveness employment certification form. So I'll come back to that in a second. But this is what this person graduated in 2020. And to best I can tell, right, their loans are with Great Lakes, best I can tell, they have not chosen a repayment plan. Right? It's just listed as being in the forbearance, which in this case is the pandemic forbearance, right? So you contrast that against the previous one that said pay as you earn, right? That loan servicer officially processed that application for that person, right? Now, you may not want to go through your loan servicer, right? You can go through studentaid.gov to apply for an income-driven repayment plan, right? So you can do this electronically using the self-certification, or if you've got a tax return on file, you can use that tax return, right? So you can have, I am not currently on an income-driven plan, I want to apply, right? So you can apply here, right, and get your loans into an income-driven repayment plan officially, but look for some kind of confirmation that your loans are actually in that repayment plan, right? So download that file, upload it, see if it actually reflects that repayment plan in there, showing a repayment plan rather than forbearance. And if not, keep asking until they actually provide something that says what plan you're in. Look through their website too. Like on the AidVantage website, you can find, or at least, if you're in a repayment plan, they'll tell you what repayment plan you're in. You have to go dig around a little bit in there, but you may find that it's actually reflecting that. And if you can't find evidence of that, then keep asking questions.
We have more questions, but so you just left the what we know section, right? So
I did, yep.
Okay, so how do you file for a refund if you've made payments during forbearance?
So that you're going to have to request from your loan servicer.
Mm-hmm.
Yep. So I would go directly, call your loan servicer, or they may even have a way for you to request a refund through their portal during for the pandemic payments.
Okay. I'd say let's keep going. And there's more here, but I know you're going to get to some of it. So
great. So I just want you guys to all know that any veterinary student has access to the VIN and VIN Foundation Student Debt Message Board areas where you can get personalized assistance. All right. So here's some links to that. But I also want to show you that here, if you're logged in to the Student Debt Center while you're using it, right, you can see here that I'm logged in with my VIN username and password. It knows who I am. It'll save your files that you do here. It'll provide you this link to the Student Debt Message Board area, right? So you can log in.
And all these links will also be in the email along with the recording.
Right, and this will take you directly to the Student Debt Message Board area that you have access to, right? So if you have VIN access, then it'll take you to the VIN student debt message board area. If you're not an active VIN member, that's okay. We have a VIN Foundation version of this. We just need you to set up a username and password. It'll be the same as your VIN username and password was, right? So you may just need to reactivate that, but you can post in here, right? Questions, like there's a lot of questions in here about tax filing status, right? This is a person who actually went back and amended their 2020 tax return to change it from filing separately to filing jointly so they could get a past refund, because the only reason they were filing separately was to reduce their student loan payments, but they haven't had to make any payments during the pandemic forbearance period. So they went back and amended that filing and got an additional $3,000 or $4,000 back just based on changing their past tax filing status, right? So there's a lot of money on the table here, right? Just wrapped up in how you choose to treat your student loans. Now, how far back you want to go is up to you. I think you can only go back and change your tax filing status for 3 years or so. So, that's above and beyond, but it just illustrates what you can do. And there's, we went through and tallied up all of the money that this particular person saved just through their tax filing status in the pandemic forbearance period. And it was something like $70,000 or $80,000 in the last 2 years, right? So that's a lot of money, right? I mean, those are fully funded retirement plans. Those are down payments on homes. I mean, this is some money that you have available to you if you just work through the options that you have on the table. Any other questions when it comes to student loans, physical exams, and just identifying things regarding the pandemic forbearance period?
Yep. Someone said, if I'm in an income-driven repayment plan, have the time that has elapsed with the pandemic added to my forgiveness, like the pay-as-you-earn plans. Do you want me to read that again?
Well, so forgiveness, there are two separate forgiveness types, right? So you've got public service loan forgiveness, right? So public service loan forgiveness is a type of forgiveness that you're eligible for if you have the right loan types, you're using the right repayment plan, like an income-driven repayment plan, but also working for an eligible public service employer, right? And if you do all of those right things for 10 years, then you can apply to have the remaining balance forgiven tax-free, right? That's public service loan forgiveness. When you use an income-driven repayment plan, they also have forgiveness provisions, right? But you make payments based on your income for a maximum amount of time, right? So pay-as-you-earn has a 20-year maximum repayment window. You make payments based on your income for 20 years, or if you pay the balance off before then, you don't have to worry about anything, right? But if you still have a balance remaining at the end of the 20-year period, anything that's remaining will also be forgiven, right? But that forgiveness may be counted as taxable income, right? All of those forgiveness types are covered by this pandemic forbearance provision, right? So the time that you spent, if you entered into the pandemic forbearance period using an income-driven repayment plan, all of that time counts towards forgiveness, right? For those of you that graduated into the pandemic forbearance period, if you consolidated and chose a repayment plan immediately after graduation, then that would count towards forgiveness from that time. If not, your forgiveness clock started after your grace period ended with the switch of your loans into that standard 10-year plan, hopefully, right? Technically that should happen, but I haven't seen anybody talk about whether or not that will count yet, right? So we're going to have to, once the pandemic forbearance period ends, there's going to be a grand accounting exercise of how far am I along in any of the forgiveness plans, right? And you're going to have to be part of that discussion with your loan servicer and the Department of Education, right? So I ask my loan servicer every year, how many months of qualifying forgiveness time do I have? Right, I do that once a year when I renew, but we haven't had to renew in a while, right? And the loan servicers are notoriously bad at counting this time, right? So you have to have some kind of accounting of that time, right? So some of the documentation of when you applied, when you were confirmed to be in an income-driven repayment plan, right? The student aid data file will help you piece that together, right? So it won't count it for you yet, right? But hopefully we'll get to a point where that'll work too. But we all have to be kind of an active participant in this, but it is worth your time because we're talking about tens, if not hundreds of thousands of dollars on the table over the course of repayment, right? So be part of that exercise. But yes, any of the pandemic forbearance period time that you were in an eligible forgiveness plan will count towards forgiveness.
Okay, so we've got a few more here. If we are graduating this year, and then I'll get to the fish because there is a comment about that. If we are graduating this year, when would we need to apply for an income-based repayment plan before the loan provider automatically places it in the standard 10-year plan?
Yeah, so we covered that. We covered that one. Yeah, so that was you want to consolidate as soon as your loans officially enter that grace period and apply for an income-driven repayment plan. And we're going to actually do a whole new separate webinar for the graduating class of 2022, the new grad playbook that we've done every year for the last, I think, 3 years, or maybe 4 years, where we talk specifically to the graduating class of what you need to do and how to do it, right? So, but know now that we're going to do that webinar, and you're also, the way I can just boil it down quickly is start a consolidation loan as soon as your loans allow after graduation, apply for an income-driven repayment plan.
Yep, and because you've registered for this, you will get updates on that. Tentatively, we're looking at May 18th, but it will be around in May. Okay, next question is, if your loan servicer switches, do you need to recertify IDR or will it transfer automatically?
Oh, no, good question. You shouldn't have to, right? But just like whenever you move from one apartment to another or one home to another, things get lost in the shuffle, right? So there has been a lot of moving of loans lately, right? So I talked about Navient moving loans to Advantage, Fed loan servicing quit, right? So loans are being distributed across the loan servicers. If you have public service loan forgiveness credit, you'll get moved to Mohila. If you don't, you'll get moved to any of the other servicers that are out there. Granite State was another one that quit last year. So anytime your loans are moved from one loan servicer to another, you should make sure that everything gets transferred over appropriately. Some of the things that often get missed are things like the repayment plan you were in, right? So confirm with your new servicer which repayment plan you should be in and what the repayment plan amount is, and also confirm that they received all of that previous history of your loans from that prior servicer as well, right? And if you can get in there and grab that information too, it's good to have it on hand just in case.
Okay, we've pretty much answered this, but just so someone hears it, as a new graduate, how might the student loan forbearance extension affect whether or not I should refinance my student loans? When does it make sense to refinance?
Yeah, so we haven't gotten. We're going to get to that in the next session here. But generally speaking, if your debt to income ratio is greater than 1, then I would steer clear of any kind of refinance. Right? There's just too many benefits that are baked into your federal student loans that you're going to forfeit by refinancing your student loans, and it's just not worth a lower interest rate unless your debt to income ratio is going to be less than 1. Pretty much from the get-go, and will remain there for the duration of repayment, right? That's the only time that I would ever recommend somebody use a private loan refinance.
Okay, I recertified during the forbearance and my payment went up. Once it restarts, will it stay with the new payment or will it go back down to the original one?
It depends, I guess. So if you recertified, I'm not, that one's kind of confusing to me. I would have to look at that one. I'm not sure why they would have processed an increase in your student loan payment when there was no renewal due. They generally weren't doing that. But when the pandemic forbearance benefit ends, it will enter repayment with whatever payment is reflected on your either student aid data file or what your loan servicer is showing as your current monthly payment that is shut off due to the pandemic forbearance, right? So that one is one that I would want to look at more closely because that doesn't quite pass the smell test for me.
Okay, I've suggested they post on the boards as well. And then we are, I've had my loan servicer Navient previously automatically take me out of payee because I overpaid on one of my loans too much. I then protested and they put me back in payee plan. Did my clock restart when they did that?
Ooh, so that's a good one. That's a good learning one for everybody. So I think what you got caught up in is what's known as the pay ahead feature, right? When you pay more than is required on your student loans, they are automatically set up to take that extra payment and assign some some amount of time that additional payment would cover you for future minimum monthly payments due. For instance, if you had a payment due of $1,000, your minimum monthly payment was $1,000, and you 1 month paid $3,000, you would be paid ahead by 2 months on your loans, which means you wouldn't have a payment due for the next 2 months. And if you're using auto pay, they won't take a payment, which means you didn't make a qualifying payment for those 2 months that you were in auto pay. That pay ahead feature wreaks havoc with income-driven repayment and public service loan forgiveness. So the best thing I can recommend is don't do that, right? Don't make additional payments to your federal student loans when you're using an income-driven repayment plan. Particularly if you're going to hit forgiveness, it doesn't make any sense, right? But that can be a side effect complication of making extra payments towards your student loans. Ways to avoid that is to have your loan servicer turn the pay ahead feature off, right? It's not usually something that you can do without calling them and asking them. But again, the best way to do it is just set it on auto pay and don't pay any more than you have to, right? There's very, very few good reasons to pay more than you have to towards your student loans, right? There's usually always something better that you can do with your money than paying extra towards your student loans, right? So use that as kind of a learning experience. But no, you will not receive credit for the months that you were paid ahead under the income-driven repayment forgiveness clock, but it doesn't restart it, right? So when they put you back on a normal pay-as-you-earn schedule and you were making regular minimum monthly payments again after that time frame, whatever amount of monthly payments you made before plus the new ones would still be the total forgiveness credit that you have, right? So the only thing that restarts your forgiveness clock is a consolidation loan. So that's why we recommend you do it as soon as you can after graduation, because most of you don't have any forgiveness credit yet at that time, right? So, generally speaking, you don't lose any forgiveness credit unless you do a consolidation loan.
So along those lines, somebody asked, can you clarify the recommendation for consolidating loans for the 2022 class? I've heard that consolidation gives more short-term relief rather than long-term.
Yeah, that doesn't make a lot of sense to me. I'd have to hear more about why that would be the case. There are almost no bad reasons to consolidate your federal student loans. The good way outweigh the bad, if there really is any bad. The only really thing that you lose the ability to do with a direct consolidation loan is to target various loans separately, which when it comes to federal student loans generally doesn't make a lot of sense to do anyway, right? Snowballs, avalanches, all those things don't generally work very well for federal student loans. The benefits of consolidating, right? Simplifying your loan portfolio, choosing a loan servicer, getting the forgiveness clock to start sooner rather than later, securing a $0 payment from the get-go as you're getting started as a veterinarian. All of those things way outweigh any of the features you might be able to have access to by not consolidating, right? So both the short and long-term benefits are in alignment with the consolidation loan.
Okay, there's more, but do you want to kind of pause here and?
Let's keep going.
Okay, well, somebody said rainbow trout.
That is a rainbow trout, yeah. So good guess.
So we will get to the rest of these questions. We're just going to get through a little bit more.
All right. So when it comes to repayment, choosing the best repayment strategy for your situation, when it comes to federal student loans, the best is not always the fastest, and the fastest is not always the cheapest. Again, this is really a unique feature of your federal student loans. Generally speaking, any other debt that you're going to have in your life, the faster you pay it off, the less expensive it's going to be, right? That is not always the case with your federal student loans, particularly with the income-driven repayment plans. right? It's just how they work mathematically. And it has to do with these forgiveness provisions and the amount of time you're in repayment and how that discretionary income calculation works, right? You can choose to use that to your advantage or not, right? And it really, depending on where you are on the debt to income ratio spectrum, will determine how big of an advantage that might be. But when I assess student loans, right, because they're usually one of the major expenses that we have in our lifetime, I'm looking for a way to minimize the risk of something like that, right? And the best strategy for me reduces the risk to myself and my family, maximizes my monthly cash flow, and ideally reduces my total repayment costs, right? I know that I can always get these first two, right? This kind of aligns with the question about the private student loan refinance, right? If I know that my federal student loans will always allow me to achieve these first two, which in my opinion are the most important, right? So I know that if I walk out of my front door tonight and get hit by a bus, right, my loans will never have to be paid by my wife or my future daughter, right? They will go away with me, right? So my federal student loans have that protection baked in. Not all private loans or other loans will have that kind of protection baked in. Maximize my monthly cash flow. I know that if my income goes down because I got hit by that bus and I can't work for a while or ever again, right, that my monthly student loan payments will go to zero. If my income is zero, my payments can be zero, right? If my income goes up, the payments go up, right? So it tracks nicely with variations in my income, right? We'd like to think that our income is always going to go up every year, but reality has a way of, showing us otherwise, right? We're probably going to take a hit income-wise as my wife goes on maternity leave and we get adjusted to, adding a new person to the house, right? So that's going to allow us to reduce our monthly student loan payments, but that means that we can still keep on track with our other financial wellness. Just because our income went down doesn't mean our student loan payment is now a higher percentage of our overall budget, right? It still stays at the same percentage because our payment is based on a percentage of our current income, right? So that is a huge benefit. And ideally, if it reduces my total repayment costs, great. If it doesn't, how big of a difference are we talking about here, right? Because I can probably make up the difference by doing better things with that money, assuming that I have a pretty significant difference between what my income requires me to pay and what something like maybe a standard 10-year plan payment requires me to pay, or a private loan refinance payment requires me to pay, right? So those are the assessments that I make when I'm walking through my student loans and, whether or not I should, or how much priority I should assign them in my overall budget. So for DVMs making $100,000 plus a year, is public service loan forgiveness truly better, cheaper than choosing standard or graduated repayment plans and trying to pay off the debt quickly by paying more than the minimum monthly payment if extra money is available? Yeah, and this, again, this is always kind of where these end up, right? So it's, yes, we are seeing veterinarians make more money than they ever have in the past, right? But just because you're earning 100 grand a year or maybe even 200 grand a year doesn't necessarily mean you should be using something other than an income-driven repayment strategy, right? It's that debt to income ratio that is really the determining factor there, right? If I'm making 200 grand a year, but I've got $400,000 of student debt, income-driven repayment is still going to be my best friend. If I'm making 100 grand a year and I've got $75,000 of student debt, well then, yeah, maybe an income-driven repayment plan is not going to be all that beneficial, right? So it really depends on what your debt to income ratio is, not just what your income is. And if you've got extra money in your budget, then I would challenge you to think about all of the other things that could be in your budget. And if you've already checked all of those boxes and you've still got extra, well then, hey, go for it, right? What a great problem to have, right? But I don't recommend that anybody sacrifice any critical area of their financial wellness just to pay more than their income requires towards their student loans. So again, you've got two ways that you can pay back your student loans. You can take a time-driven approach, which is pretty much every other debt that you'll ever have in your life. Your student loans can be paid on a time-driven plan as well, like a standard 10-year plan, extended, graduated. So that prior person mentioned a graduated plan. I don't ever recommend graduated plans. Graduated and extended plans are not helpful, right? They're never better than an income-driven plan. So I don't see any use to them, right? So for me, the decision is always Do I use an income-driven plan, or do I use something like a standard 10 or something even less than 10? Right? Extended, graduated, or just going to increase the amount of time I'm in repayment and the amount of interest I pay as compared to an income-driven plan or a shorter time-driven plan. But then the calculation becomes, will I pay less in a income-driven plan than any of those standard or shorter repayment timeframes, right? And the income-driven plans are, again, something that's only eligible for your federal student loans, right? And these are the ones that are currently on the books, right? You can upload that file into the My Student Loans and see which one is going to be that you're eligible to use. But as we already talked about, pay-as-you-earn is generally one of the more favorable ones. The problem with time-driven approaches, right, particularly something like a 10-year plan, is that it doesn't care about your income, right? So if I've got $200,000, $300,000 of student debt, which again was quite common for this audience tonight, right? If I want to pay based on a standard 10-year plan, my payment is $2,100, $3,300 per month, right? I can extend that to 15, right? The payment comes down a little bit, but look at how much more the total cost goes up, right? If I extend that out to 20 years, which is the same time frame as a pay-as-you-earn plan, the payment comes down again a little bit, but look at how much the total repayment costs go up, right? And the problem, again, if I just take two states as an example, right? If I've got $100,000 income, my after-tax income in Colorado is $6,000, a little less than $6,000 in Illinois, right? That's a third of my take-home pay, or half of my take-home pay, right? That is not conducive to a comprehensive financial wellness plan, right? That means you're sacrificing critical elements of your overall financial wellness in order to maintain this kind of payment, right? And I don't recommend anybody do that, right? And the good news is you don't have to. So the first thing I want to do is calculate what is a time-driven plan, like a 10-year plan, require me to pay based on my student loan specifics, and what kind of percentage of my after-tax take-home is that, right? If it's more than 10 or 15%, then it's too much, right? Because I know the income-driven plans will allow me to pay 10 or 15% of my income, right? So that's the exercise that I'm going through in determining where my student loans fit priority-wise in my cash flow. We've already talked about the refinance. They're really risky. And unfortunately, even you'll see this in a simulator, right? I mean, I've run simulations where even if I assume that you could somehow magically refinance your student loans at 0%, the income-driven plans are still more favorable. So just because you might be able to get a lower interest rate on your student loans doesn't make it a good deal, right? Chances are the monthly payment is going to be higher. And in order for you to get that super low interest rate, particularly right out of school, they're likely going to require a cosigner, right? So somebody like your spouse or a family member that's going to be on the hook if you can't pay your loans, which means if you get hit by that bus, now your spouse or that family member is paying for your student loans, right? So that's a really, really complicated topic, and it's generally, you cannot boil student loans down to an interest rate, right? So I would really recommend against that. Again, unless you're in that debt to income ratio less than 1 scenario, and you're gonna comfortably stay there for the duration of repayment. This is just to show you that there's a lot of different features among the various income-driven repayment plans. All of these things are baked into the student loan repayment simulator, except for ICR. We do not simulate ICR. It's generally just a terrible income-driven plan. So it doesn't make a lot of sense to use it. This is what it'll show you what the maximum repayment periods are, right? Again, this is what sets the maximum amount of time you'd be in repayment. You can pay the loans off sooner than that if your income's high enough and your payments are high enough to do so, right? But this is what triggers forgiveness, right? If you have a balance remaining when you hit that maximum repayment period, that's what triggers forgiveness in a non-public service loan forgiveness scenario. This also speaks to the differences between the plans that allow you to file your taxes separately from your spouse, right? So spouse's income considered, right? Only if you file your taxes jointly. Pay-as-you-earn and IBR are plans that allow you to separate your income from your spouse if you file your taxes separately. under normal circumstances, right? So non-pandemic forbearance circumstances. You can change your tax filing status from year to year. And like I talked about before, you can even go back in time and change your tax filing status, right? So depending on what your circumstances are and how they evolve over your career will determine whether or not you should file jointly or separately from year to year. Repay, unfortunately, even if you file your taxes separately, they still want to see your spouse's income, right? So that isn't very beneficial to file your taxes separately, at least for student loan purposes, if you are using repay. Okay, so here's the debt to income ratio guidelines, right? So we can use these debt to income, this comes from running thousands and thousands of simulations for our colleagues over the last 10 years, right? And some themes emerge, right? And that's where these debt to income ratio guidelines come from, right? They're not absolute, but they tend to be the result that you're going to see when you run your simulation and start to adjust the inputs. When your debt to income ratio is less than 1, then your payment using an income driven repayment plan is generally going to parallel a standard 10-year plan amount, right? So in that instance, those payoff numbers are very similar, right? So this is why I'm usually comparing an income driven plan against a standard 10-year track, is because that's the standard, right? The standard has been that if I graduate with a debt to income ratio of 1, that I can reasonably pay off my student loan balance in 10 years using roughly 10% of my income, right? That is essentially a standard 10-year plan. However, right, we are now in an era where most people that are graduating from something like vet school are at the 2 spectrum of the debt to income ratio equation, right? So the standard 10-year plan doesn't apply anymore. It still can, but it's going to be a punishing amount of your take-home pay, right? Hence, we have these income-driven plans that try to bring us back to something that resembles this scenario, but then has all of these weird permutations to it, like forgiveness and unpaid interest, right? And having to provide your income documentation every year, right? So this has been our solution to higher costs, but not necessarily higher incomes, immediately starting after school. So if you're at the debt to income ratio less than 1 spectrum, time-driven plans can work well. Repay works excellent for those scenarios, right? So for those of you that are going to graduate or have graduated and you're starting to see a debt to income ratio less than 1 and you anticipate that staying there, I would recommend repay. Repay can have you paying your loans back to 0 in less than 10 years, right? While still kind of keeping a lot of the benefits that we've been talking about. For those of you that are going to head into internships, or maybe you're in an internship or residency and you anticipate your income to be greater than your debt balance after you finish that training, repay is a great plan for that, right? But that requires a little bit of certainty, right? The only ones that I generally recommend use that are ones that, whether you complete that residency or not, your debt to income ratio is probably still going to be less than 1, right? So, if there's any question at all, then use pay as you earn, right? Because that's going to provide the ultimate flexibility. Refis, be careful, right? Only when you're less than 1. And again, that's going to be if you're less than 1 after graduation or shortly thereafter, right? Those refinances, you can't undo that, right? So if you find yourself in a scenario that may be less than ideal a few years down the road and you've refinanced, that's going to be really tough to navigate. And again, think back to that whole risk management profile I talked about previously. That really is the most important, is being able to control the risk with something like a student loan balance. If your starting debt to income ratio is above 2, right, which again was the majority for those of you that provided that debt and income signalment form, income-driven repayment plan is going to be your best option, right? Pay the minimum, plan for the forgiveness, right? Take advantage of the pandemic forbearance. Don't pay any extra than you have to. Look for ways to use your tax return or your changes in your income circumstances to achieve the lowest allowable payment as possible, right? That will reduce your total repayment costs. Use time to your advantage to plan for forgiveness. We'll talk about that in just a few minutes. 1.5, you're in the gray zone, right? Depends on where you are. If you're closer to here and you're heading towards less than 1, and how many years are you after graduation, and how long have you been in repayment, right? Or is there a chance you might creep back up or just stay there I'm always going to lean towards income-driven repayment because I'm going to see an appreciable difference between that standard 10-year plan payment and my income-driven plan payment. And I can do better things with that extra cash flow. So just in terms of numbers, for those of you that reported your information to me, right? So 12% of you were in this less than one scenario, right? So maybe about 20% of you were in this gray zone, and 2/3 of you were in the two or higher. How do you guys calculate your debt to income ratio if you're married? Type some thoughts about that one in the chat, right? Because this is another one that always comes up. You know, I always hear well, we're going to live off of one spouse's income and pay all my student debt with the other, right? So how do you think it's best to treat your debt to income ratio when you're married, whether your spouse has debt or not?
So Tony, while we're taking a moment, I would say two things. Please, everybody, remember to put your questions in the Q&A window so we can make sure to get to them. I know there are a couple in the chat and we will get to those. But if you can, please put them in the Q&A window. It helps us track them a little bit more. And then also, do you want to take a quick moment, Tony, and talk about being able, you did mention it, that everybody is able to get access to the student debt message boards and how you were able to do that. We will include in the email along with the presentation materials and the recording. It's a quick, simple application, just need some basic information. And I will also put that link in the chat window right now.
Great. I do see another question here too. This does seem to be targeted at the newbies. Yeah, no, I think that just the newbies tend to ask a lot of questions about getting started in repayment because the whole concept is so unfamiliar. For those of you that have been out, the same concepts apply, right? So I am looking to see, I'm going to go get my student aid data file. I'm going to upload it into the My Student Loans tool, and I'm going to look and see which repayment plan I'm currently using and which ones I'm eligible for. If you graduated in 2010, I can tell you that it is highly unlikely that you're eligible for Pay As You Earn. But you are probably likely for IBR 2009 and revised Pay As You Earn, right? So if you're using one of those, great. Then all of the things we talked about in terms of benefiting from the pandemic forbearance and calculating your payment to see what would my payment be under repay or income-based repayment versus what might it be under a standard 10-year plan payment. Is there a significant difference there, right? I'm running my simulations to see, am I on track to hit forgiveness? If I've been out of school since 2010, I may have 10 years of qualifying forgiveness payments at least, right? So I want to use the student loan repayment simulator to factor that in. Right? I want to choose the plan I've been using so we can account for any forgiveness time that I might have, run that simulation based on my income, any marital information, children that are in the house, my best guess of my taxable income going forward, right? And the simulator will show you the best course of action going forward there as well, right? And if you do have questions about any of that, then that's where you would head over to the student debt message boards, right? But I'm still going to ask you for the same things that we asked you to do before the session, right? To fill out the student debt and income signament form. I really need to see that information to help answer your questions, right? So you're going to do that. You're going to post on the student debt message board. I'm going to ask you for a simulation that you've run so we can see how are you processing this information and how can we show you how to work through this on your own so you can go through this exercise more confidently every year. Right? So that same exercise is going to apply whether you graduated 10 years ago or you're graduating 6 months from now. Cool. Let's see. I'm going to kind of look over in the chat here. Okay, great. What's the difference between income-driven repayment versus Pay As You Earn, revised Pay As You Earn? So Pay As You Earn and revised Pay As You Earn are income-driven repayment plans, right? The collection, the umbrella, if you will, of the income-driven repayment options include income-based repayment. There's two different versions of income-based repayment depending on when you started borrowing, right? You're either eligible for one or the other. There's Pay As You Earn and there's revised Pay As You Earn. Right? We'll tell you which of those you're able to use if you go grab your student aid data file and upload it into the My Student Loans tool, right? So those are the available income-driven repayment plans. I graduated in 2008, have been on IDR used IBR and I'm wondering if I should look into pay-as-you-earn. So if you graduate in 2008, you're not going to be able to use pay-as-you-earn. You might be able to use revised pay-as-you-earn depending on what your loan portfolio looks like, right? So we talked earlier about 2010. There was this different loan option that was out there and available called the Federal Family Education Loan Program, right? And it was kind of random as to whether or not you were assigned direct loans or federal family education loans, right? But that's the value of going to get your student aid data file from the studentaid.gov website. That's going to have all of those specifics in there. And if you upload it into My Student Loans tool, it will pick through all of that and show you which repayment options that you have available to you, regardless of when you graduated, right? So you can get that student aid data file. It may take you a little bit more time since it's been a while since you applied for student loans, but you can create that account with studentaid.gov, obtain that file, and then start that process. That's kind of that physical exam that we were talking about. You can switch from one plan to another, right? Now, again, those of you that graduated before 2010 or even, 2010 to 2014, you may have a more complicated loan portfolio that includes several different loan types. And that's going to impact whether or not you can safely move from one plan to another without a consolidation, right? So that's the part that we want to assess specifically, is whether or not you need to use any kind of consolidation or it makes sense to do any partial consolidation depending on your circumstances. Okay, so how do you calculate the payment, right? So how do you know what your payment would be under an income-driven repayment plan? You can certainly use the student loan repayment simulator, right? But this is a pretty basic equation, right? So we can do some back of the napkin math, but some concepts that you should pick through, right? Your adjusted gross income versus your gross income. This is a particular timely topic, right? Everybody generally is walking around with a good idea of their gross annual income, right? You probably don't have a good idea of your adjusted gross income until you file your taxes, but pay attention to that number, because the adjusted gross income is one of those gold standards, if you will, that the Department of Education will always accept as valid documentation for your income, right? And there's usually some incentives there to contribute to things like retirement plans or health savings accounts or health insurance premiums or flexible spending accounts that will reduce your gross income if you're taking advantage of those things down to an adjusted gross income, which is usually less, which has you paying less in taxes, but also has you paying less towards your student loans, right? Which is what I call stacking incentives. So that's what we're going to walk through here. But for those of you that are not sure whether or not you want to do an income-driven repayment plan, then think of it this way, right? Does your taxable income exceed your student debt balance, right? Yes or no? Will it, right? If so, when? And will it stay there for the duration of repayment, right? Because those are the only things that generally prevent me from recommending an income-driven repayment strategy. Here's how they calculate your payment. It's a percentage of your discretionary income. They define discretionary income as your taxable income, right? This is where that adjusted gross income number plays in. Your taxable income less 150% of the federal poverty guidelines. The federal poverty guidelines come directly from the Department of Health and Human Services. They get updated every year around January, loosely based on inflation, right? So those have been tracking upward, right? So when I say tracking upward, they provide a bigger allowance. The poverty input is higher, right? We're subtracting a higher number, your discretionary income goes down, right? So as an example, $100,000 of taxable income with a family size of 1, the discretionary income is 100,000 minus 1.5 times this 13,590, which is the federal poverty threshold for a family size of 1. My discretionary income is about $80,000. If I take 10% of that and divide it by 12 to get a monthly payment, my income requires me to pay $663 per month using pay-as-you-earn or revised pay-as-you-earn. $995 per month using the older version of IBR, which is at 15% of my discretionary income. Right, so this is my baseline. What is my income? What does the income require me to pay depending on the repayment plan that I have access to? What am I paying, right? What am I currently paying? How does that stack up against a standard 10-year plan payment, right? How does that stack up against the payment that I might be required to pay once the pandemic forbearance period ends, right? Is it greater or less than what this number shows, right? So is there a magic number you should pay towards your student loans? Yes, it's this percentage of your discretionary income, right? That's the maximum amount that the federal government requires you to pay towards your student loans. And for most of us, this is a lower amount than many of us are currently paying, right? Which means we have some money on the table that we have access to reallocate to other areas of our financial wellness if we need to. How much is your income required to pay? Are you paying more or less? And how does your taxable income, your adjusted gross income, differ from your gross income? Right? Know those differences when it comes to student loan repayment. Just to give you an idea of, how your payment changes as your income increases, right? I mean, I get a lot of people that are always wondering, well, what happens if I earn, quote, too much money? Generally, that's not a problem, right? You can still use an income-driven repayment plan and earn as much as you want or as much as you can, right? And your payments will track upwards as that income starts to hit your tax return, right? But I think people tend to always overestimate how much they should be paying towards their student loans. Even when you start to get up into some of these big six-figure numbers, the monthly payments required by the income-driven repayment plans are generally not that high as a percentage of your monthly take-home pay. All right, I am going to skip ahead a little bit here. Okay, so let's talk about this stacking incentives piece, right? So your adjusted gross income, right? There are tax incentives in the code, in the IRS code, to incentivize certain financial behaviors, right? Like saving for retirement, like having health insurance, right? Generally, those things are looked at as a societal good, right? We don't want a whole bunch of people that get to their golden years that have no way of financially supporting them, right? So we put some tax incentives in place to help you save for retirement long-term, because generally people don't like to do those sorts of things, right? We have decided that it's generally a good thing for you to have health insurance just in case something happens, right? So we give you some incentives if you're paying for some of those things out of pocket, right? Same with like health savings accounts or flexible spending accounts and dependent care incentives, right? They do all of those sorts of things through the tax code. All of those items are things that you should be actively pursuing, right? Retirement savings, we're already late to the game, right? We have to figure out a way to start saving for retirement sooner rather than later. There's a lot of tax incentives baked into the code to do so, right? Those things are going to funnel through to your taxable income, right? So if I'm contributing $10,000 a year to a 401k, right, it's going to come off of my gross income. My taxable income is going to be $10,000 less than my gross income, which is going to result in a lower monthly student loan payment, a higher amount in my retirement savings, and a lower amount of taxes that I pay to the federal government, right? To numerically represent this for you, if I can figure out a way to reach the maximum allowable contributions for a 401k plan in 2022, which is $20,500, I can reduce my federal income taxes by about $5,000 a year and reduce my student loan payments by about $2,000 a year outside of the pandemic forbearance period, right? So, I see a lot of our colleagues, particularly recent graduates, who forego a lot of these retirement savings. Thankfully, one of the side effects we've seen with the increase in demand for veterinary services recently are employers that have better compensation benefits, including things like 401ks, including things like employer matches to your 401ks if you're contributing to them, right? But I see people voluntarily not taking advantage of these things because in their mind, it reduces the amount they receive in their paycheck, which reduces the amount that they can pay towards their student loans so they can try to pay down their student loans faster, right? Not only have we demonstrated that that may not be a good strategy compared to an income-driven plan, but you're just going to end up paying more in taxes than you have to too, right? And generally the people that hate student loans also hate paying taxes, right? So don't shoot yourself in both feet, trying to pay your loans off faster than your income allows, just so you can pay more in taxes and potentially pay more towards your student loans, right? So it does, it makes sense to go through these exercises. So, to see numerically how much money you might be leaving on the table. When it comes to forgiveness, right? So this is where this gets really complicated. Right, forgiven amounts, I've had to update this just in a recent couple of years, right? So forgiven amounts may be treated as taxable income, right? Before this past year, that was forgiven amounts will be treated as taxable income, right? But Congress has exempted student loan forgiveness from being treated as taxable income. The problem with that is that recent exemption is only good for 2021 through 2025. Almost nobody is going to experience student loan forgiveness between 2021 and 2025, right? But it does open the door to Congress continuing to exempt student loans from being treated as taxable income. Because generally, any forgiven debt is usually treated as taxable income. But there is a special exemption in place right now for student loan forgiven balances that do not require them to be counted as taxable income. I don't know if that's going to be continued or not, right? I was reading an article the other day in a pretty notable outlet that pretty much assumed that this all but guaranteed that student loans would never be taxed. Forgiveness would never be taxed. I think that's a stretch, right? But it does open the door to making that a possibility, right? So in 2025, 2026, we're going to find out if whatever Congress is in place then, what their appetite is for continuing that exemption, right? And they may keep doing it in like 5-year increments, which is going to drive me nuts, but should drive you nuts too, right? Because then you have to wait and see, well, where am I in that? Am I going to have my loans forgiven during one of those exemption periods or not? So just to be safe, I'm going to plan as if I do have to pay a tax, and maybe I won't. And if I get to the point that my loans are forgiven, I don't have to pay a tax, well, I've got a nice bonus account of money that I can use to enjoy that I didn't have to pay to the IRS to complete my student loan repayment strategy, right? So be careful what you're reading out there. If you're going to use an income-driven plan, if the student loan repayment simulator is going to show you that you have a forgiven amount, plan for it, right? Use time to your advantage, as I showed you I'm doing with my current forgiveness plan, to help use time, dividends, capital appreciation to help cover that potential forgiveness. Okay, let's talk about public service loan forgiveness, right? Because we had a lot of questions about that. So only direct loans are eligible for public service loan forgiveness, right? So this is the value, again, of grabbing your student aid data file, uploading it into the My Student Loans tool, and looking to see what loan types you have. If I come back to the one that we uploaded earlier, I can see here that this person has all direct loans. When it comes to public service loan forgiveness, I also have an example of someone who has a couple of documented months of public service loan forgiveness credit, right? So let me upload that one just to show you how you can use this to see if you're on track, right? So that's one of the hardest things to know when it comes to public service loan forgiveness. Am I on track for forgiveness? So this is somebody that graduated in 2018, right? So here's their principal. Again, this is that unpaid interest that those of you that graduated after the pandemic forbearance are not going to be familiar with, but this is a quite common occurrence with income-driven repayment plans because often the monthly payment is lower than the interest that accrues each month. I can see the loan types. I see this person has all direct loans. Great. Loan servicer, Fed loan servicing. That was the servicer who was previously monitoring public service loan forgiveness progress. That has now been determined to be MOHELA, right? So Fed loans quit and they're in the process of transferring all their loans to new loan servicers. But if you have documented public service loan forgiveness qualifying time, as this person has 2 months documented in this file, your loans will automatically get moved to Fed loan servicing, or in the future, they will automatically get moved to MOHELA, and they will monitor that progress as long as you keep providing that public service loan forgiveness employment certification form. Right? So if I'm working towards public service loan forgiveness, in addition to providing my annual income documentation for my income-driven plan, this person is using pay-as-you-earn, right? I'm also going to submit this public service loan forgiveness employment certification form, so I can start this accounting of my eligible public service loan forgiveness time. And once I hit 120 months, I can apply to have my remaining loan balance forgiven tax-free under public service loan forgiveness. Right, so this data is baked into that student aid data file. If you upload it in here, we'll pick through it and look for it. Right, if you're working towards public service loan forgiveness and you see other loan types in your portfolio other than direct loans, where you see a loan servicer other than Fed Loan Servicing or MOHELA, or a repayment plan that's not IBR, repay, or pay, then something's wrong. Right? And we want to help identify that so you can fix that sooner rather than later.
So somebody's asking, Tony, with the changes to PSLF certification, if I haven't certified previous qualifying work years, can I go back and do that now?
You can, absolutely, and you should. Right? And there's some extremely beneficial, and those links are in here too under this public service loan forgiveness tab. Right? There's a temporary expanded public service loan forgiveness provision, right, that goes back and looks at repayment plan types that you may have been using that weren't initially eligible for public service loan forgiveness. And there's also this limited waiver period that is in place between now and the end of this October, where even if you had the wrong loan types while you were working for a qualifying employer, they'll still go back and count that time. Right? Now, you will have to consolidate something like this applies to the federal family education loans, right? They were the big bugaboo that had a lot of the early cohorts of people not being able to document proper public service loan forgiveness time, right? But this limited waiver said, screw that, right? If you were working for an eligible employer and you just had the wrong loan type, consolidate your loans and submit this special application under this limited waiver. If you do that before the end of October 2022, we'll count all that time too. Right? So the public service loan forgiveness, everybody keeps, even though those of you that submitted questions about public service loan forgiveness, they always have this qualifier on there. Hope to receive public service loan forgiveness if it's still in place by the time I get there. It's not going anywhere. Right? There has been no attempt to take away public service loan forgiveness, and every attempt to expand it beyond what it was ever intended to do. Right? And now we're trying to make sure everybody gets into that qualifying period. Right? If they were tripped up by some of the really, really confusing provisions that were there before that were designed to just have that first cohort fail from the get-go, let's remove all those barriers and try to capture them. Yes, it sucked. It was a lot stressful for them. We're going to try to make that happen for them. And going forward, it's a lot easier, right? And I know it doesn't seem like that, or if you read the news, it doesn't read like that, but it is a hell of a lot easier to make qualifying payments for public service loan forgiveness since after 2010 than when this first went into effect, right? So there's going to be a lot of people that benefit from public service loan forgiveness in the coming years as we iron out all of these wrinkles. Don't throw that out just because you've read some awful reports on that, right? Chances are, like this person has all direct loans, right? None of those things that tripped up those people exist for this person's portfolio. They're using the right repayment plan. They have the right loan servicer, and they're counting their time, right? They're doing everything they can possibly do, right? Now, some of you with older loan portfolios, it's going to be a little messier, but there are options for you to get this number to be as close to 120 or even beyond, so you can receive public service loan forgiveness.
Okay, this person's asking, under the temporary PSLF waiver, if we were working for an eligible employer, but in forbearance and still making partial payments, would those payments count?
Oh,
and I know
man.
you could have answered this before, but.
Yeah, forbearance, no, unfortunately not. So they have talked about trying to make that also eligible. Forbearance is awful, right? And other than this very, very, very unique pandemic forbearance period, forbearance and deferments are things that you should avoid like the plague after you graduate, right? Again, except for this special pandemic forbearance period. Forbearance periods don't count towards anything, right? So they give you a $0 payment, but if you think about it, the times when you request a forbearance, your income is usually low or nothing, right? So if you're using an income-driven repayment plan and your income is low or nothing, your payment will be low or nothing. And those payments will still count towards forgiveness. Unfortunately, again, the limited waiver that apparently they are talking about making forbearance periods available for public service loan forgiveness for military folks. And I'm not even sure that they got that through yet. But if they do get that through, then that may open the door to expanding those forbearance periods like you described to also being eligible for something like public service loan forgiveness if you were still with an eligible employer during that time. But as of right now, no, unfortunately not, right? But again, learning experience. Everyone here learned from that. Borrower who had that happen to them learned from that, and don't use a forbearance ever again, right? Don't use a deferment ever again. You can use an income-driven repayment plan and make sure that those periods where your income is low actually qualify towards forgiveness. So here's all the links to all of that stuff and information in terms of the expansion of public service loan forgiveness as well as the limited waiver period. I see this come up all the time too. I wish I can wave a magic wand and put the people that have the highest debt to income ratios in the public service jobs, but it doesn't always work out that way, right? There's some of us that are just wired to spend our careers in public service oriented gigs, right? And if you have a debt to income ratio less than 1, you may not reach public service loan forgiveness, right? Your payment may be such that you'll end up paying the balance to 0 before. Still not a bad problem to have, but just because you're working for an eligible public service loan forgiveness employer, if your debt to income ratio isn't high enough, you may not reach public service loan forgiveness, right? And I see that kind of come up all the time for those people at the lower end. Just to show you that this does happen, right? This is a veterinarian who received forgiveness for more than $400,000 of loans, while working for a humane society just a few months ago, right? So she got hers triggered through the temporary expanded public service loan forgiveness provision, right? So this is happening, right? It's happening for our colleagues, right? It's going to accelerate in the coming years because, again, the pool is much bigger than it ever was before. And a lot of this is actually happening automatically, right, without you having to do anything. But for some of you that have very complicated loan portfolios, you may have to participate in that process. You never know where your career may take you, right? What the ones that are heart wrenchers for me, right? People that come out of school, guns blazing, working for private practice and, making some good money, and they're paying a ton towards their student loans while they're not really saving anything for long-term or don't have any other assets or wealth to show for it. And all of a sudden they come across this magical opportunity to work for, academia or state government or whatever, right? And then now they're in an eligible public service loan forgiveness employment opportunity, and they can have their loans forgiven if they still have a high enough debt to income ratio, but they can't go back in time and get that money back that they paid towards their student loans, which ultimately could have been forgiven, right? So again, you just never know where your career can take you, and you don't want to have to use those valuable resources, those limited resources we have towards paying towards something that you don't necessarily have to pay more than your income requires you to pay towards. Right? Leave those options open just in case. Okay. What questions do we have on repayment?
Okay. So, can you change plans more than once, IBR to repayee back to IBR?
You can change plans as many times as you want, but it's not, I wouldn't recommend changing a lot, right? There are certain circumstances that are unavoidable. Right? We started using IBR 2009. There wasn't repay available. When repay became available, we did the assessment and decided it made sense to switch from IBR to the newer repayment plan, right? There's really not a lot of good reason to switch from one to another. Choose the one that's the most flexible and most beneficial for you, so you don't have to switch. There are consequences to switching, right? So I showed you earlier somebody that had a lot of unpaid interest, this person, right? If they were to switch from pay-as-you-earn to, say, repay for some reason, they're going to take this unpaid interest and they're going to add it to the principal. The higher the principal, the more interest you accrue. And unless you hit public service loan forgiveness, you're going to maybe pay for that if we have to pay a tax at the end, right? So keep the plan switching to a minimum, right? That side effect is worth avoiding unless there is some real compelling reason for you to switch from one plan to another, right? I can't really think of a good reason that you have to switch more than, let's say, once over the duration of repayment, right? I've got actually a really good example. This is a good time to bring this one up. So that one was already ready for that. So this is a person who graduated in 2017. And this is, again, why I can't stress this enough. Go get your file, right? Upload it into the student aid data file and look at this income-driven repayment eligibility tab, right? I can see here, this one actually illustrates a lot of really good things, but let me try to stay focused for a second. This person is using IBR 2009, right? Income-driven repayment eligibility. They are eligible for IBR 2009, pay-as-you-earn, and revised pay-as-you-earn. There is never a reason to choose IBR 2009 if you're eligible for pay-as-you-earn. This person actually chose repay after they graduated, switched to IBR 2009, but should be in pay-as-you-earn, right? They're kind of doing the round robin of every repayment option available, right? But they're also, their principal has suffered from that, right? They've experienced a couple of different unpaid interest capitalization events. Right now, if we don't have to end up paying a tax on forgiveness, or this person ultimately ends up earning public service loan forgiveness, that won't matter, right? But I'd rather pay less than I have to. And one of the ways I can do that is by choosing the most flexible and most beneficial repayment strategy from the get-go, right? And sticking with that plan, right? Whether my income goes way up or it goes way down, right? Even if I end up in a debt-to-income ratio less than 1 scenario down the line, I still want to stay in that pay-as-you-earn plan and pay that 10% of my income, right? So there's really not a good reason to bounce around from one repayment plan to another, right? Identify the most beneficial one that's available to you and stick with it, right? And you'll reduce the side effects of switching from one plan to another. So the other thing.
Somebody just said, can you repeat that? Why would 30K be added?
Well, in this instance, for this example, it'd be this 14. That is one of the side effects of switching plans, right? If I use an income-driven plan, right? And the reason why I use an income-driven plan is because generally speaking, the payment is going to be lower based on my debt-to-income ratio. There's a good chance that that payment will be actually below the interest that accrues. So I will generate what's called unpaid interest during repayment, right? So if I'm generating unpaid interest, I want to keep this unpaid interest in this unpaid interest bucket and off this principal, just in case I end up having to pay a tax or I ultimately end up paying this balance to zero, right? Because the higher my principal balance is, the more interest I'm going to accrue. Switching repayment plans is a capitalization trigger, right? So that is an event that will force this interest from being taken from the unpaid interest category and added to your principal. Anytime you switch a repayment plan, or if you switch from repayment to deferment or repayment to forbearance, coming out of a forbearance or deferment will add the unpaid interest to your principal. The big exception being coming out of the pandemic forbearance period, there will be no capitalization. Right? Again, that is a very, very, very special forbearance period that we're all in right now. But switching repayment plans, using a deferment or forbearance, right? Those are triggers for adding unpaid interest to your principal. Refinancing, right? If we come back here, let's say this person decided that, screw this, I want to refinance my student loans, and somehow was able to find a private lender to do that. This $31,000 is going to get added to the principal. Even if it's a lower interest rate, that's going to have an impact on the total monthly payment and the total amount paid. right? So you generally want to avoid having that unpaid interest added to your principal, and you avoid that by providing your income documentation on time and making sure that you're avoiding this plan switching.
Okay.
I see a question here. I have no idea what interest rate to guess for the simulator. What would a guess be? A good guess be? It depends on your balance. It also depends on your when you graduated, right? If you really want, you can go back and fill in your interest rates, right? If you want to do the calculation, right? I'm tracking interest rates for veterinary school loans on the VIN Foundation blog here, right? Every year we update them, and there's a history of them, right? So depending on the loan types you have, when you borrowed them, we know what the interest rates are, right? So, you know, if you've got $230,000 of student loans and you graduated 2 or 3 years ago, then I'm going to guess that your interest is just less than 6%. So maybe 5.75 with the auto pay discount. If I graduated, you know, 2012 or sooner, then my interest rates were closer to that 6.8, 7.9%, right? So they're going to be a little bit higher. So I might put, you know, 6.8 or 6.75 in there, right? So it you know, you can put some guesses. I would, you know, depending on what your balance is when you graduated, but you can't go wrong with just, you know, throwing 6% in there just to get an idea of what your loan repayment simulation would be. But the folks that have graduated more recently are going to generally have a lower interest rate. The folks that graduated a longer time ago are going to have a higher interest rate, right? Just based on how interest rates have worked over time for federal student loans. Now, if you graduated a way long time ago, like early 2000s, well, your interest rates might be in like the 2 or 3% range, right? So it really depends. If you really want some more guidance on that, that would be an area where you could post in the student debt message board area, and we can walk through that based on your loan portfolio.
Okay, 2011 grad, currently on IBR, 190K debt, making 145. Does changing to repayee make the most sense? Have been in repayment for 10 years. What does reaching forgiveness mean exactly?
So reaching forgiveness means, and this is where I would encourage you to run that simulation. You're using the loan repayment simulator, right? So sorry, that was the wrong tab. Tab hell here. So let me see, what did we say with 2011 grad? Now, again, 2011 sets off alarm bells for me that your loan portfolio might be a little more complicated, right? So it might not be all that straightforward for you to switch from something like IBR to repay. It depends on what your loan types are. I'm particularly looking for differences between direct and FFEL program loans. So you said 190K. I would want to break that up into principal and unpaid interest, right? Chances are you may have an unpaid interest balance, right? If you do, we want to account for that separately, right? So I need a little more information there. So if you've been using IBR, right, I'm going to probably, again, I'm going to put 6%. Actually, in 2011, I'm going to probably put 6.6% in there, right? If you've been using repay for the last 10, or I mean RBR for the last 10 years, I can put that safely in there. I know I'm going to extend this for another 4 months. I think, what did you say your income was? 100? 110? What was that?
140, 145.
145. And then we're going to have to look at what we're doing over time, right? And is this your gross income? Is this your adjusted gross income, right? Are you contributing? Are you hitting the 20,500 maximum on something like a 401k contribution, right? If so, then I might want to reduce this to 125, right? But let's just stick with what you told me to start, right? If you're paid on ProSal, I'm generally going to use something higher to increase my annual income. If I'm paid on a salary, I'm going to probably use something lower, right? Because not everybody's walking into their boss's office and asking them for a raise every year, right? But they probably should be if they could justify it, right? But that's going to also impact your simulation. Are you married, right? I didn't hear any of that in there, right? That would be part of this equation. Do you have kids, right? Also part of the equation, right? So we run this right now, right? If I'm on IBR, it looks like I am right on the cusp, right? If I keep making payments based on this income input, which would be about $1,500 a month, right? I would pay that balance to zero in a little more than 14 years, and I've got 15 years before I would hit forgiveness. So it's going to be really, really income sensitive. Now here I also see that there's not a significant difference between the IVR payment and the standard 10-year plan payment, right? $600, yeah. I mean, if I'm not maximizing my retirement, my tax advantage options, if I'm not, hitting the maximum on a health savings contribution or any eligible FSA contribution that I might benefit from, if I don't have a robust emergency fund, if I'm not happy with, my home situation, right? If I can use that extra $600 in flexibility in a way to shore up those other areas, then I'll just keep making the IBR payment. I also want to look and see, maybe am I eligible for repay, right? I don't know that. I'd have to see your loan details to see if it'd be an easy switch for you to go from IVR to repay if you have all direct loans. If so, my payment goes down by a third, right? It's $1,000 a month. In that case, I do hit forgiveness, right? So by reaching forgiveness, that's what I mean here. Is my income that I entered into the simulator show that I hit forgiveness, right? I have 15 years because I already have 10 years of eligible forgiveness payments. I've got 15 years more before I would hit forgiveness under IBR 2009 or repay. Do I still have a balance remaining, right? For repay, I would. For IBR 2009, I wouldn't, right? But I'm really close, right? So I would want to refine this simulation more, knowing more about your income information. I would also want to refine this more, knowing more about your loan portfolio to see if it's an easy switch from IBR to repay. Right? And the only way I can see that is by using your file to review it in the My Student Loans tool to see if you have loan types other than direct loan types in there.
And they've said they are not married, no kids, 6,500 unpaid, and AGI.
Okay, great. Yeah, so then the next question there is, are they all direct loans, right? If they're all direct loans, then that would favor switching to repay, right? If they're not all direct loans, then
all direct except that 7,000.
Okay, well then that would still, to me, favor switching to repay, right? Paying the minimum, planning for the forgiveness here, and using that additional, because now I've got an extra $1,000 a month on hand, right? Who couldn't use an extra $1,000 a month, right? Unless, again, your financial plan is, bulletproof, then you may not, right? So that's.
I was going to say that segues into another question we've had, which is there a recommended account to save for the tax? For example, like a high yield savings versus a regular savings?
Yeah, and I would start with a high yield savings, right? But as I showed you with my forgiveness plan earlier on, right, you can probably do better than that, right? Even with 15 years before you hit forgiveness, that's a pretty long time frame, right? So you can probably take some minimal risk to improve that return beyond what a savings account is going to offer you, which is, somewhere between 0.5% and maybe 0.6% right now, right? So if you think you can increase that to something a little bit more by taking a little bit more risk on, right? This is where financial planners are really helpful, right? If you're not comfortable in investing or the robo-advisor thing doesn't make any sense to you, then you can enlist the help of a professional to help craft a portfolio for you to achieve a little bit more higher return based on your risk tolerance, right? And if I can get, maybe 5% on my forgiveness savings here, I have to allocate a minimal amount to cover the tax that might be due. And again, I may or may not have to pay the tax, right? I'm going to watch and see how that unfolds as Congress is going to deliberate in 2025 to see if they should extend that provision, right? So that's how I would be walking through that. The remaining, again, coming back to, maybe on the table is, should I refinance this with a private lender, right? If you switch to repay and this income projection was reasonable enough and panned out, right? The effective remaining interest rate that you're paying over that 15-year period is 1.78%, accounting for the forgiveness, assuming you're paying the forgiveness, right? That's a pretty damn good deal, right? So I wouldn't I wouldn't shift away from the federal student loans. I probably would consider switching from IBR to repay, right? Looking to maximize areas that might be able to help take advantage of something like a increased 401k contribution that might reduce some of my taxable income, so I can boost my retirement savings, lower my monthly student loan payment, push more of this into repay forgiveness, and have more money in my monthly cash flow that I can do other things with.
So someone's asking, if you change IDR plans, your unpaid interest is added to the principal?
That's correct. And in this case, I think he said he had a, I don't remember the exact number, but it didn't sound like a lot, right? So you know, we can add it, right? So if it was 190, and I think it was maybe 14,000, right?
I think it was 7.
Oh, was it 7? Okay.
I can look again. Yep. Sorry. All direct, but 7. That's what he said.
All direct was 7. How about
6,500 unpaid?
Okay. Right. So that's separate from the principal, right? So when you switch plans, that will factor that in, right? So it'll factor in the switch. So here you'll see it's 190, but in repay it's 196,500, because in order to get into repay, they're going to capitalize that interest, right? But it still comes out to making more sense than paying the remainder in IBR if you wanted the cash flow flexibility and you wanted to see if there's a potential that Congress may exempt that forgiveness provision going forward while maintaining the additional cash flow flexibility, right? So that would be an example of how we assess moving from a plan like IBR to repay, given the circumstances that that person nicely provided during this session.
If one changes from IBR to repayee, do you lose the time you've been paying 2011 grad in repayment for 10 years?
No, you do not, right? The only thing that triggers a loss or a restart of your forgiveness clock is consolidation, right? Because consolidation physically replaces your old loans with a new loan. Right, so switching from one plan to another will preserve forgiveness time as long as you are in a forgiveness plan and you're switching to another forgiveness plan. Right, a standard 10-year plan payments actually count towards forgiveness too, right? But if you make standard 10-year plan payments for 10 years, you're not going to have anything left after 10 years, right? So you know, there are, you know, the eligible forgiveness payments generally are preserved for the income-driven plans, but if you had made a payment under a standard 10-year plan, that would also count.
How many years does it take for IBR plans to be forgiven?
So the original version of IBR 2009 is 25 years, right? You have to make 25 years of forgiveness payments, right? So making the minimum payment on time every year. And if you still have a balance remaining, then it's forgiven.
Does refinancing prevent the 20 to 25 year forgiveness?
Yes, because in a refinance, you are replacing your federal student loans with a private loan. Private loans are not eligible for income-driven repayment. Private loans do not have any forgiveness provisions.
Is there a way to avoid losing the time my loan is on payee if I consolidate 8 years after graduation?
I'm not sure why you'd want to do that. If that person is still here and could provide more information on that, I can't think of a really good reason. If you're already in pay-as-you-earn and have 8 years of qualifying payments towards it, I'm not sure why you'd want to consolidate, right? Because pay-as-you-earn is only eligible for direct loans. So there wouldn't be a good reason for you to consolidate 8 years into repayment if you're using pay-as-you-earn.
Okay, with IBR plans, we'll see if they respond. With IBR plans, would a decrease in income still count towards repayment if it was due to a drop in work hours? In other words, is part of the IBR requirements to be consistently working full-time rather than part-time or unemployed temporarily?
You don't have to work at all, right? There's no work requirement for income-driven repayment. There's an income requirement, right? So if you don't have any income, you won't have any payments, right? But if you don't have any payments, you're going to have a whole lot forgiven. And if you have a tax at forgiveness, that could be a problem, right? So it doesn't, the only one that has an employment provision is public service loan forgiveness, right? You have to be working for an eligible employer in order to satisfy all of the requirements to make a public service loan forgiveness qualifying payment. If you don't have any income for the other income driven plans, you won't have any payment due. It'll be zero, right? But you'll still be accumulating qualifying forgiveness time with those $0 payments using an income driven repayment plan, which is why they're so beneficial in those periods where, hopefully brief, you don't have any income, right? So moving, maternity leave is a huge one, right? Please, please, please resist the temptation to let or request your loan servicer put you into forbearance during a maternity leave. Have your payment recalculated to a lower amount based on whatever your income is at that time. It can go all the way down to zero, right? And you will still be working towards forgiveness. You'll accrue unpaid interest once we're out of this pandemic forbearance period, but it won't get added to your principal, right? So avoid those forbearance periods. Have your payment recalculated if you experience a zero or low income situation.
If a future employer has a private loan to give you at 2% APR, is this still not better than an IDR?
Well, it depends, right? You got to run that through the simulator, but you're going to see a lot of circumstances. If I come back to some of these other simulations that we ran, right, you're going to see a lot of circumstances that have some really, really low effective interest rates, depending on your debt to income ratio. The higher your debt to income ratio, the lower the effective interest rate is going to be. So yes, you can see income-driven plans be beneficial, more beneficial than even a private refinance at 2%, right? So, and the private refinance is, again, not going to come with any of the benefits, right? If something doesn't go as planned in that circumstance, you're still stuck with that private loan with a payment that's due, right? So just because the interest rate is lower doesn't mean it's a good deal, right? There's a lot of other factors that go into that beyond just the interest rate.
My parents are on a standard repayment for Parent Plus loans for my undergrad. Should they still make payments targeting the 7% as opposed to 5% loans pre-COVID during this forbearance?
I'm not really sure I understand that one, but Parent Plus loans are a whole different beast. Parent Plus loans are the one example where they may want to consider the income contingent repayment plan, ICR. That is the one income driven plan that you can use for Parent Plus loans. So depending on what your parents' income is and what your parents' tax filing status is, they may benefit from ICR, which would act similarly to these other income driven repayment plans. But Parent Plus loans are unfortunately really, really frustrating. They have high interest rates, they're not very flexible, and oftentimes those parents don't have a lot of income to help to extinguish them. So ICR is an option. The extended repayment plans are an option depending on what their income is, or the beneficiary of the Parent Plus loan is also an option to help pay those down.
Okay, DVM with 200K debt and 200K income, spouse with no debt and 350 in income. We've been married filing separately for years on the massive assumption we want to keep DVM's reported income low. But are you saying that filing jointly would not actually hurt? How can we tell? Or are you saying that filing separately is normally the right choice when we're not in a pandemic and filing jointly is okay for right now only because of the pandemic forbearance?
Exactly, the latter. Yeah. It's kind of a special exception period, right? You know, you can, if you're filing separately to keep your student loan payment low, right, and there's no payment that's due, then there's no reason to file separately, right? You can file jointly in the short term here for say last year, this year, right? Maybe next year, who knows? Right. But once we come out of the pandemic forbearance period, and depending on when you're due to renew again, will determine whether or not and when you should potentially go back to filing your taxes separately again.
When we calculate our debt, when we calculate our debt to income ratio, should we be using our adjusted gross income?
I would, right? But again, I've been doing this long enough where, almost probably 90% of the people who tell me their income are telling me their gross income, right? Most people don't have a walking around knowledge of their adjusted gross income. If you do, A+, right? Congratulations, great job, keep doing it, right? But while we're in this tax filing season and everybody has to file their taxes in a couple of weeks here, take a look at what your adjusted gross income is and make a mental note of it and how it's different from what you thought your gross income is, right? But if you know your adjusted gross income, I would always use that in the simulator, always over your gross income. And thanks for asking that, because it's one of those things that I've been struggling with, how to convey that concept to people without confusing the hell out of them, right? But as you file more tax returns, you will get more and more familiar with your difference between your gross income and your adjusted gross income, and focus on that adjusted gross income. Focus on all those compensation benefits that you may have access to that will impact that adjusted gross income, and see how much you can impact it.
If I want to work towards PSLF and I have not consolidated my loans yet, should I grad class of 2021 all direct loans?
You probably don't need to consolidate. If you have all direct loans, then and you graduated in 2021 and you were using an income-driven plan, or maybe you haven't chosen a plan yet, then it probably doesn't make a lot of sense for you to consolidate. If you're going to start working for a public service loan forgiveness employer, by submitting the employment certification form, your loans will get moved to MOHELA automatically, and they'll start tracking your progress. So you really don't have to consolidate in order to do what you described.
So that goes to the next question. Does anyone know if there's a specific place on the MOHELA site to determine how many months you are towards forgiveness, or do I need to try to talk to a human?
You'll probably need to talk to a human. FedLoan did have that portal where they were demonstrating the same thing that we're showing you in the My Student Loans tool, right? So if I can find the person's file who has the eligible time, if I haven't closed that one already, right? They showed you something like this, right? But this is very new, right? MOHELA was just recently kind of deemed to be the official monitor of public service loan forgiveness. So I imagine that is coming, right? It would have to, right? But if it isn't available yet, then I would call and ask them about that. But another way for you to do that is to obtain your student aid data file, upload it into the My Student Loans tool, and check the public service loan forgiveness status, right? I mean, the whole reason we built this was because the loan servicers suck. It's just the reality of this, right? And they're so inconsistent, and you need some other way of verifying or refuting what it is they're showing you or telling you, right? And you can do that with this tool, right? That is really to help provide you that information ammunition to go to your loan servicer and say, yeah, what you're telling me doesn't make sense, right? Not based on what I'm seeing in my student aid data file. But the student aid data file, you can't read that. No normal person can read that. But we built a tool here to help you read it, right? So you don't have to drive yourself crazy picking through that text file.
If changing during the pandemic, unpaid interest is still added?
Yes. So if you switch from one plan to another and you had unpaid interest even before the pandemic forbearance, then yes, it's going to get capitalized.
Okay. My balance, principal and interest is about double on FedLoan, which I believe to be accurate, than it is on studentaid.gov. Any thoughts on why this may be?
Yeah, I'd have to see that. That would be one where I would encourage you to upload your file into the My Student Loans tool, and we can walk through that on the student debt message board area. And just so again, you can get to that. If you're logged in here, you'll have a link to the student debt message board folder on the Student Debt Center while you're using the My Student Loans tool. right? So it'll take you right to the student debt message board area. So you can post there. You can even post anonymously. There's an anonymous checkbox in the posting window that allows you to keep your information anonymous.
Okay, if you have been on the standard 10-year repayment plan, is there some way to get any kind of credit for those past payments towards forgiveness, or is that just money lost?
No, you should be able to get credit for that. So it's going to be tricky in terms of how to document that, right? So I would be looking for my loan servicer statements, anything that confirms that I was using the standard 10-year plan payment, the payments that I've made that said that I've made the minimum on-time payment each time, right? And ask them, ask them for a log of your qualifying forgiveness payments, right? And those standard 10-year ones should show up.
Okay, I might have missed it, but regarding the recertification date for IDR, I'm wondering how this affects people who graduated previously and have been in the IDR repayment for a while, graduated in 2011. I thought Tony said the extra year before needing recertification was only applicable for new grads. At least that was my impression.
No, that's for everybody. Yeah, that's for everybody, right? So I have a file here that I was using as an example. Here, this person. This is a perfect example. If your anniversary date has not yet been updated, right? So I showed you one earlier where the anniversary date was July of 2023, right? In the future, that is updated, right? Based on what we currently know about the pandemic forbearance and the recertification deadlines. This one has not been updated yet. Right, so this is an example of a file that has not been updated. The anniversary date is in the past, which implies that you need to renew, but you don't because the pandemic forbearance doesn't require you to renew. But what the pandemic forbearance recertification details say is if it hasn't been renewed, what you can assume is that they're going to add a year at least to this, right? So this would be May of 2022, right, is the new anniversary date. We also know that nobody is going to be required to renew until at least November of 2022. So that's not right either. So I suspect that this person's anniversary date will ultimately get updated to say May of 2023 when it finally does get updated based on what we know about the rules, right? So that's how you can apply that, the current information that's out there in terms of recertification deadlines.
Okay, how do we request, we usually cover this. How do we request a refund for payments made during COVID forbearance?
That you're going to have to do through your loan servicer, right? So you're going to have to either call them or they may even have a request a refund electronic option in their portal for payments made during the pandemic forbearance.
Okay, and then I'm looking for, there was a question in chat, so I'm looking for that one. But in the meantime, okay, found it. How does all of this change for a 2001 grad? I believe that I have been on a 30-year repayment plan, approximately $700 per month, principal at $63,592. Should I reach out to you directly or via VIN? Sounds like many of the people are newbies. I think you might have mentioned that one earlier, but
yeah, that one's going to depend on your circumstances. If you started a 30-year repayment plan 20 years ago, right, depending on what your income and family size and tax filing circumstances are, you may not see a lower payment on an income-driven repayment plan, right? So it's going to depend on what your goals are. You also may have, if you graduated in 2001, your interest rates on your student loans might even be 2 or less than 3%, in which case, keep doing what you're doing. Right. There was a person, it's very similar to somebody who submitted their Signalment form mentioned how they were paying down their mortgage. And after they were going to pay down their mortgage, they're going to then pay down their student loans. And it's like, well, my mortgage is at like 3%, right? I'm not in a real hurry to pay that down, right? I can do better things with my money to achieve a higher return long-term than paying down really low cost debt. Right. So I'm not in a terrible hurry to pay down my mortgage or to pay down $60,000 on a student loan that might be at 2%. Right. So I'm going to keep paying the minimum. I might look to see what my income driven plan payment would be, but I'm probably just going to keep paying the minimum and looking to do other things with the money to try to increase my return on the extra money that I might have in my budget.
Okay, one more, and then we'll get to the fish comments. Should we bug our loan provider to update that anniversary date on IDR recertification?
You know, I wouldn't. You know, they're already pretty incompetent. So I'm not going to rely on them. That's really going to be something that probably comes from the Department of Education. So with all the changes that are going on, it'll happen, right? But you can go to if we go to studentaid.gov, and this is in the links that are in the slides that we've already covered.
Tony, while you're there, somebody also asked, where is my studentaid.gov file?
Okay, so let me first do this. So if I go back, this is the student aid page up here at the top, student loan repayment pause extended through August 31st. If I click on that, right, there's a lot of information, right? And in terms of income-driven repayment plans, right, it talks about recertification deadlines, right? All this information is in here. And it talks about, too, here, if your recertification date falls between now and November, it will be pushed out by 1 year. It gives you the example. It even says something in here that, hey, right here, you may see a recertification date that's earlier than November. We are working to get those updated, right? This is the Department of Education, right? So give it some time. They'll get it updated. But just know that nobody has to provide any documentation before November 2022, and it's probably farther out in the future than that. Right? So give it some time and it'll get updated. So you want to see again where the student aid data file is.
Yep, they just said, is it super obvious because they're not familiar with that.
Yeah, it's not, I wouldn't say it's super obvious. And again, don't try to do this on your iPhone, right? You're going to have to do this on some kind of device that allows you to save a file to that device. Oh, it looks like they're maybe doing some active updating right now.
Perfect timing for us.
Yeah, right. So I'll log in here. But there's also a video of this on the My Student Loans page of how to do this. Yeah, this site is really crawling right now.
I mean, considering what was announced today, it's not surprising, right?
Yeah, I may not be able to demonstrate that right now, but sorry about that.
I just put a link to the My Student Loans in the chat.
Yeah,
so.
there's a video and a couple of screenshots on what that looks like in there.
Okay, they said they did find it eventually in it's the up right corner somewhere, like download my data.
Yep.
Okay.
Yep.
Wonderful. Okay, salmon.
Yeah, this is a kokanee salmon.
Oh,
yeah,
okay. The second person said sockeye salmon.
It is. Well, so a kokanee is a landlocked sockeye, right? So the sockeyes they have the ocean life cycle, and we have some bizarro ones here in Colorado that are landlocked, right? They don't have access to an ocean, so they call them kokanee salmon, but they're a type of sockeye salmon. And they turn these awesome colors in the fall.
65 questions done.
Great. Excellent. We never even got to the financial wellness slide. So
I know those saving questions. Yeah. I was wondering if I was kind of saving those. So I was like, oh, I know he's going to get to that problem.
Yeah, that's all right. Well, we covered some of that during the session, and you guys you'll have a link to this and you can feel free to click through those. But, all of this is really hopefully to help you, reduce the anxiety around your student loans and really focus on financial wellness, right? There's so many great things you can do with your money other than just paying your student loans. So start looking for those things. And you'll find that there's a lot of positive interactions between doing those things and keeping your student loan payments low and your taxes low.
Okay.
And yes, I am releasing those fish. I do not eat any of the trout that I keep. Or catch. I release them all. Yay, indeed.
Well, we will be sending out an email within the next couple of days. Thanks everybody for your questions. Please keep a lookout for that email. There will be a recording in the email. I know some of you joined late, and we will also be sending additional links, all the links we talked about today, as well as links to the message board and the app. You do not need to be a VIN member in order to access the VIN Foundation resources. Anything else you want to add, Tony?
No, thank you, Jordan, for moderating and digging out all the questions. And thank you, Matt and Becca, for helping to facilitate and moderate as well. And, if you have any questions, feel free to reach out or, use the student debt message board areas and the free tools that are available on the VIN Foundation Student Debt Center, and we'll get you the answers that you need.
Wonderful. Thanks so much, Tony. Thanks everybody for joining, and have a good evening.
Yes, thank you all.